All right, good afternoon, everyone. Welcome to our LACERS Planning for Retirement seminar. And my name is Heather, and I will be starting off our seminar today. So let me go ahead and get this slideshow rolling. All right, so let me just read this aloud to you first. This is our disclaimer. So this presentation is intended to provide a summary of the benefits established by the Los Angeles City Charter, Los Angeles Administrative Code, and the LACERS Board rules. In the event of discrepancies in this presentation, the plan provisions will govern at all times. Representatives of LACERS, such as myself and or Nathan, who will be presenting later, cannot offer financial, legal, or tax advice. So please consult with your financial planner, attorney, and or tax advisor as needed. Now, additionally, this presentation is for Tier 1 members. Tier 1 members are LACERS members hired prior to February 21st, 2016. Those hired after February 21st, 2016 are Tier 3 members, so they would have different benefits. So before we go any further, I just want to let you know we are recording this seminar. And that's because some of your coworkers would like to view it after they weren't able to attend today. So this is being recorded. Additionally, I'm the first presenter. And then we also have a special guest. His name is Steve. He's from Voya, AKA Deferred Comp. He will be presenting in the middle before we take our break. And then after, we will have health benefits with Nathan Herkelrath, also from LACERS. So before we move any forward, let me start a poll that we have here for you. And this is just to get a feeling of who we're talking to today. So just have a few questions. So I just started the poll. So if you can go ahead and take that poll right now, and then I'll just give a few minutes before we move forward. So while you're taking that poll, I just want to introduce a little bit more about myself. As I said, my name is Heather Ramirez. I've been with the city, actually it'll be 13 years on the 1st. So 13 years towards retirement. So, you know, I've been here a little bit, but I got a ways to go. So you know, it's been a good run here. I've been with LACERS about 6 years now. I'm currently a senior benefits analyst, which is equivalent to a senior management analyst. Previously, I worked over at LAWA, so any of you that worked at the airports before, I may know you. And I was a personnel analyst over at LAWA. So that's my job history. Additionally, I have some private industry experience. I worked for the Walt Disney Company for 19 years. So some of my jobs there were working the rides such as Jungle Cruise. So I apologize if I have any dry humor during this seminar. It's because of that. I blame the Jungle Cruise. So I apologize in advance. But you know, Disney is Disney. So a few of you have, okay, 26 of you have voted, so not quite 100% yet. So I'll give a few more seconds, but it looks like so far, most of you have been here at least more than 5 years. So maybe some of you are looking to retire soon. How many departments? 3 or more, 15%. Majority of you have actually only been with one department. And let's see. Getting closer to 100%, just a few more seconds. All right, I'm going to end polling now. All right, and I'll share the results with you just so you can see who you're in this seminar with. So, you know, as I said, more than 5 years, 100% of you. So no Tier 3 employees here in this seminar. How many departments have you worked with? Some of you have been in several. Majority of you have been in only one. And when you're planning to retire from this city, looks like about 50% of you more than 6 months from now, 24%. So about a quarter of you are planning to retire very soon. And then about a quarter of you not sure. So that's who we're talking to today. So thank you for taking the poll. And while we're going through this seminar, we have our question and answer option. So while I'm speaking, Nathan, who's on the other end, he'll be answering any questions that you type in. You won't be able to speak during the seminar. It's only going to be typing. So if you have any questions, please use the question and answer button on on our Zoom presentation here. And then Nathan will be able to answer those, or if it's something we'll be covering later, he'll let you know. And then while Nathan's speaking later, I'll be answering those questions on the question and answer. So if you have any questions, just use the question and answer, not the chat. And if you raise hand, there's no way to speak. So please just use the question and answer. Okay, so let's go ahead and move forward. All right, so let's talk about some of the topics we're going to be discussing. So I'm going to go over what LACERS overview is, explain what service credit is, your retirement eligibility and allowance, the money you're going to get, basically. And that's very important to a lot of people, money. How much are you going to get in retirement? So we'll definitely go over that in the first half. Your retirement options and selections. Talk about taxes, Social Security and COLAs in retirement. When are you ready to retire? Some like mental preparation and the actual retirement process, how that works. Then we'll also have our special guest, Steve from Voya, talk about deferred comp. Deferred comp and Voya are not part of LACERS, but it's something that you can participate in, and many of you likely already are, and it's useful in retirement. So that's why we have Steve come in to talk to you about that. So he'll talk it right before the large break. And then after the break, Nathan's going to come in and talk about leaving city service prior to retirement. Also going to talk about survivor benefits, your health and dental benefits in retirement, health and dental enrollment, Medicare. Lots of people have questions on Medicare. Nathan's going to go over that on the second half. So if you have any health or Medicare questions, please hold those until Nathan begins speaking, because it may be answered while he's talking. And then finally, some legal planning tips. So let's go ahead and talk about the LACERS Board of Administration. So our LACERS department, we have approximately now about 200 employees, and we are governed by a Board of Administration. So we meet on the second and fourth Tuesday of every month. Currently, due to COVID, we are meeting via, not Zoom, but you can call in. So you can call in and meet, listen to our second and fourth Tuesday meetings. So those are public. So those are something you can do. You can find the information to call in on our website, lacers.org, but it's governed by 7 board members. Now those board members are, 4 of them are appointed by the mayor. 1 of them must be a retired city employee. Actually, our current board president is the one that's retired and appointed by the mayor. So the mayor has a choice in 4 of them. Then 2 are elected by us as active city employees. So as we're working right now, we have a choice to, when a seat comes up, we can vote. And so we pick 2. And then once you're retired, you still have a say in the board, because one of our members is elected by retired city employees. So that's the cool thing about this, is that 4 of the 7 members have a vested interest in working for the city, because they've either worked for the city or, or currently working. So they have a vested interest in your retirement and everyone's retirement. So that's very helpful that we have a majority vote on the board. Well, let's talk real quickly about our summary plan description. So for tier 1 members, so like I said at the beginning, we have 2 different tiers at LACERS. We have a tier 1 and we have a tier 3. Now, all of us here in this seminar are tier 1, and that's our blue booklet. If you were tier 3, the booklet is white, and you may have received one in the mail. I believe we last sent it out about 6 years ago, so you may have a copy. If you do, great. If you don't have a physical copy, that's okay too. It's on our website. Our website hosts a ton of information, including our summary plan description, so you can view that there. Since a lot of us currently are working from home, take me for example, currently working from home right now, I don't even have a physical copy at home. I didn't bring any booklets home, so everything I do is on the web. So you can view this on the web anytime. LACERS.org is viewable from anywhere that you have access to the internet. You don't need to be on the city intranet or anything like that. It's a website that you can view anywhere with internet access. So please take a look at this if you haven't before. The majority of the topics we are talking about today are derived directly from the summary plan description. So topics in there are retirement eligibility, allowance calculation, survivor benefits, and more. So please, if you're nearing retirement, This is your guide to your retirement. So I highly encourage you to view this on our website if you have not before, especially as you are getting close to. All right, so LACERS is a defined benefit plan. It's a 401A plan. So what does that mean? Well, a defined benefit plan like LACERS are professionally managed trust funds that provide specific benefits of retirement based on a formula. Now, this formula provides a lifetime benefit to those of us that retire from the city of Los Angeles, and that is awesome. It's a pension. You cannot find pensions out there available very much these days. So we are very lucky to be here with the city of Los Angeles and get a lifetime benefit through LACERS. And it's for those that are vested at least 5 or more years of continuous service. And then plans often include cost of living adjustments, and LACERS plan does. So we'll be talking about that a little bit later on during the presentation, COLAs. So right now you get COLAs while working through your union and whatnot. In retirement, you will also get a COLA, and we'll explain how that works. So we have a defined benefit plan, lifetime benefit pension. There's a formula we're going to go over on how that will be calculated for you, and you get it for the rest of your life. So pretty amazing. All right, LACERS membership. LACERS members are non-sworn, non-DWP City of Los Angeles employees. So DWP, there's 3 pension systems in the city. There's us, LACERS, Los Angeles City Employees Retirement System. There's the DWP, and then there's the sworn, the fire and police pension system. So DWP is all on their own, and then we basically have the non-sworn. And so that is our membership. As of 2016, like I said before, there were two tiers. So prior to 2016, we actually also had 2 tiers for about 5 years. We had a tier 1 and a tier 2. We abolished tier 2 in 2016 and created tier 3. Hence, there's no tier 2 anymore. So there's tier 1, tier 3. Now, membership is automatic once you are hired and your employee department certifies you the plan. So once you are hired up as full-time, you are in the LACERS plan. For part-time, if you were part-time previously, it depends on when your department put you into the plan. So you may want to ask those questions on the side. But anyone that was hired into position full-time, you were automatically entered into LACERS membership. And then after 5 years of continuous service with the city, you're eligible to collect a retirement benefit at some point. Of course, there's going to be eligibility requirements, which we'll go over, but if you've worked for the city at least 5 years and 100% of you on the poll said yes, you have 5 or more continuous years, you will be able to collect some sort of a pension. And so we contribute 11% of our gross salary towards a retirement with LACERS biweekly. So if you ever have taken a look at your pay stub, I know I'm pretty bad at it. I don't check it every week, but I did check it yesterday because I recently got a raise. So I wanted to make sure I got it. But if you take a look at your pay stub on D-Time, you can see that 11% of your salary is taken out before you get paid. So that's part of the way that your pension is funded. So let's go over how the LACERS Pension Trust Fund is funded. So here in the middle, we have the yellow, the LACERS Pension Trust Fund, and then we have 3 green boxes on the side. We have employee contributions, we have city contributions, and we have investment returns. Those are the 3 things that fund the fund. And then down at the bottom, we have 3 things that the fund funds. You have your retirement allowance, so your pension and retirement. Health benefits are not free. They're actually very expensive. So that has to be funded somehow. So in retirement, it's funded by the pension trust fund. And there's survivor benefits. If you have a spouse or domestic partner and they survive you, then there are some benefits for them. So we'll go over that as well, what those would be. But so the 3 things fund the fund and 3 things are funded by the fund. Our contributions are 11% of our salary. Investment returns vary year to year. And then city contributions, that varies from year to year as well. The only thing that's solid is the 11% that was negotiated by the MOU that you belong to and the city unions. So everyone pays 11% into there. The other ones vary from year to year. So let's go ahead and talk about service, service credit, and continuous service on this next few slides. So you may see service and service credit and think, well, those are the same thing. I mean, what's different about them? Well, there are some very distinct differences in their definitions that will be important to you when considering retirement. So let's explain service first. So service accounts for the years you've been a city employee contributing to LACERS. And then service credit accounts for the hours you've worked as an active LACERS member. So the differences there are part-time, full-time. So if you've always worked full-time, then it's going to be the same. But if you haven't, then they're going to look different. And we'll explain in a moment why that's important. Then at the bottom, let me just mention, full-time employees receive 0.03835 years of service credit per pay period. So every pay period, you get a little bit closer to retirement, just a little bit. So that's the actual calculation if you were interested in that. Part-time employees are prorated based on the actual hours worked divided by 80 hours. One thing I did not mention earlier, in case you did not see ahead of time, we do have a copy of the seminar on our website. So if you wanted a copy of these PowerPoint slides after it's on our website under our seminar section, or if you wanted to pull it up during, just in case any of you did not see those before, we do have that. So you can pull it up and you'll have a copy of this. You don't have to take a ton of notes now. You'll be able to, have all these slides after. So please feel free to take a look at our website and pull that slideshow. It's in a PDF format for you to either print or view on your computer. But so that will be on there. So let's go over an example of service versus service credit. So we have Liz, who works a full-time 40-hour week for 6 years. And then we have Dan, who works a half-time 20-hour week for 6 years. So what would be Liz's total service? Well, she's a full-time employee, so that's going to be 6 years. Now, what would be Liz's total service credit? Because she's a full-time employee, it's also going to be 6 years. Now, Dan is a part-time employee, so what would his total service be? Well, that would still be 6 years. He's been with the city 6 years. However, Dan's total service credit is going to be a little bit different here because he's a half-time employee. It's only going to be 3 years. So that's where you'll have some differences there. Service and service credit, 6 years, 3 years for him. Now, why is that important? Well, service helps determine your benefit eligibility, when you can retire, and if you could receive a health subsidy. So that's important. Service helps determine when, but service credit helps determine the amount of your benefit. So service is when you're eligible. Service credit is the money. So that's very important. The more service credit you have, the more money you're going to get in retirement, and that's going to be in your monthly retirement allowance. Something to mentally prepare for in retirement. Right now, we get paid twice a month, sometimes 3, depending where the pay periods fall. In retirement, you're getting paid once a month, and it's the last day of the month, pretty much the last business day of the month. So mentally prepare for that, especially for the 50% of you that are planning to retire within the next 6 months or so. Your paychecks are going to be different. You're going to be get paid once a month in retirement. So something to think about. And then how much health subsidy you will receive. So we'll go over, Nathan will definitely go over the health subsidies later. But very important, distinct differences here. Service, eligibility, service credit, the amount. Now, continuous service. This is the sum of your uninterrupted city service with no break in service of more than 3 years. So, for example, maybe you worked for the city for 5 years and then you left. You were like, oh, I found a cool job somewhere else. I don't need the city anymore. And then you leave. And then you decide after 2 years, you know what, I'm going to come back. The city wasn't too bad and you came back. Well, it was less than 3 years, so you can add that together, the sum before, and then once you came back, add that in. And so that's pretty cool. Now, if you had left for more than 3 years, you can't add them together. It's one or the other, whichever was longest. So the service may be a combination of city employment and governmental service purchase. So we'll talk about service options a little bit later. And actually here on this slide is the example. So the first slide here was the example I just gave. On the left with the green check right here, this person worked for 4 years, took a break for 2 years, and then came back for 5 more years, so that's 9 years. Now on the right was the second example I gave. 5 years service, break of 4 years, which is more than the 3 years max for being gone, and then they came back, so you take the bigger of the two, 5 years. So continuous service is used to determine retirement eligibility only. So for many of you, you've been with the city a very long time, so continuous service doesn't matter to you, but for some that have been in different entities, that could be something to look into. Now let's talk about your MyLACERS member statement very quickly here. So hopefully most of you have a MyLACERS account. If you don't, we highly recommend that you get one. And we did upgrade our system about 2 years ago. So if you had a MyLACERS account more than 2 years ago, maybe you opened one 10 years ago with us, those accounts were sunsetted and those no longer work because our new system is much more elaborate. It has a lot more information for you. And so you have to re-sign up for it. So if you aren't sure, if you haven't, been on MyLACERS in the last 2 years, then you likely don't currently have an account with us. And the reason why I've recommended that you do sign up for a MyLACERS account is you can do retirement estimates on your own. You can look at your service credit. You can see if you have any beneficiaries. And then most importantly, no one else can sign up for you by, like a security fraud. They're out there. There's a lot of predators on the internet, and it's actually safer to open an account. And Steve will also say that for Voya as well. They, if you have deferred comp, highly recommend you open accounts so no one does it fraudulently in your name. Now we have tons of security measures to ensure that you don't, like we send you a pen letter. So it's not that easy to sign up initially. We have to send you a pen letter for your mailing address, and then you can go in and sign up. So please request a pen letter if you don't have one already. And if you do have one already, go on here and check and see, play around with it. See if you can estimate a retirement for yourself. Look at your service credit. Make sure all your information is correct. Your demographic information while working is actually handled by your HR department. So we don't change your address or whether or not you're married or your spouse's name or anything like that while you're working for the city. That's pulled in over from Pacer and the city payroll. So that's something you'll adjust with your current department's HR. But once you're retired, then you can adjust that through us. But please, please, please sign up for MyLACERS if you have not already, especially those of you that are nearing retirement, because you will actually be able to view your actual pay stub in retirement on here as well. So you get paid once a month. About mid-month, you'll be able to see how much you're getting that month. So it's very cool. So it's not something you just need while working. You'll be using your MyLACERS account into retirement. All right, let's talk about service credit purchases and reciprocity. All right, so increasing your service credit. So service credit purchases may count towards your retirement eligibility, may increase your, service credit purchases may count towards your retirement eligibility and may increase your retirement allowance. So these are for people that have worked elsewhere or have been, doing different things, not just in this one department your entire career. So for example, let's go over redeposits first. So redeposits are for people that left the city and came back. So for the example I gave a few slides ago about, leaving the city, thinking you'd find another job in the private industry or somewhere else, and then you decided, nah, it wasn't that great, let me come back to the city, that would be for these people. So this allows current active members who previously terminated city employment and withdrew their LACERS contributions to make a redeposit and purchase service credit for prior membership. So who's eligible? An active member of LACERS who withdrew their funds from LACERS after having separated from city service. So you left the city, you thought, I'm never coming back, took your money with you, and then you say, now I'm coming back, and you came back. So in order to get credit for those years that you left, you had to redeposit that money in. Additionally, if you had a divorce, so those of you that have ex-spouses, that would really depend on the agreement, the divorce settlement that you had. But if your ex-spouse received a separate account with LACERS due to your divorce documents and subsequently withdrew the money from that account, you could redeposit using your own money to get that credit back. So that really just depends on, you know, your divorce and what was decided upon with the courts between you and your ex-spouse. So I highly recommend, if you do have any divorces, to bring your divorce documents. Actually, you can't visit us right now due to COVID, but you can discuss with someone at LACERS. So contact us, lacers.services@lacers.org, or get in contact with us to talk about submit your divorce documents so that we can have someone from our legal team review them to see if anything, you know, is going to be taken by your ex-spouse. So you can do that ahead of time. And, you know, if something is gone, then you can redeposit certain things before you retire. So I highly recommend those of you with divorces, contact LACERS ahead of time so you can provide those divorce documents for review. Now, how to apply? We have some applications. Those are on our website. Application to purchase previous city service. Let's talk about back contributions. So what is this? Well, it allows current active members who are regularly employed by the city on a full-time or part-time, seasonal or temporary basis, and were not LACERS members, to make the purchase of a back contribution. So this usually depends on how you started with the city. For me, I started with the city as a full-time employee as a clerk typist 13 years ago, so I can't make any back contributions. I've always been full-time. I've always paid into LACERS. But maybe you started with the city as a student worker or relief retirement worker, a lifeguard for rec and parks. Some of those temporary positions, those intermittent positions where you're on the pension savings plan, you get, you know, a quarterly statement every once in a while that says you have $100 in there. If anything that sounds like something that pertains to you, then you may be eligible for back contributions. So you started with the city in some temporary position, and then later on became full-time. So that time temporary can be bought. And I have a few coworkers that have done that. So that gives you more time. So say a year as a temp, well, you know, when you're close to retirement, one less year of working because you bought that sounds pretty good. So something to definitely look into if you were a temporary employee of some sorts for the city, you know, when you first started. So who's eligible? Let's go over those 3 bullets. An active member of LACERS, so you have to still be currently working, was not regularly employed by the city, either full-time or part-time, or was regularly employed by the city full-time, part-time, during that time was not a LACERS member or making contributions to LACERS. So you, basically you were an employee, temporary, and you weren't paying into the LACERS plan. So now you can. And was regularly employed by the city and participating in the PSP, aka Pension Savings Plan. During that time, you were not a LACERS member or making contributions to LACERS. So minimum of 5-year service and contributions on deposit with LACERS. So basically, you were part-time, intermittent. Pension Savings Plan sounds like something that you know of. Please look into this. The application to purchase previous city services application you're going to look for on our website. We have a whole unit that works with all of these service credits purchases. That's their only job here at LACERS. And so you'll want to talk to, with additional questions, a service credit purchase person. So please, you know, look into that if any of that sounds like you, and you may be able to get some extra credit for you towards retirement. So that's pretty awesome. Next one, public service buybacks. Now, what is this one? Well, it allows current active members to purchase service credit for uncompensated leaves of absence from the city. So maybe you wanted to sail around the world for a year and your supervisor approved it and it was uncompensated. Well, you weren't paying into the LACERS pension trust fund when you were sailing around the world and not being paid. So you can now buy that time back if you want, using the public service buyback time. Or some people go on an educational leave to go get a degree. It's rare, but it happens. It really just depends on the department you're in and whether or not the supervision, approves that uncompensated leave. And then additionally, allows current active members to purchase service credit lost due to divorce when an ex-spouse is awarded a separate account allowance. So again, if you have a divorce or an upcoming divorce, please contact LACERS and have those final divorce documents reviewed by us so we can let you know how that affects your retirement. So it really just depends, like I said previously, that what those documents say and what the agreement was with your ex-spouse. So we really recommend that you have those reviewed ahead of time. So public service buyback. So who's eligible? Current active member of LACERS, has at least 6 months of leave time while employed with the city, or the ex-spouse through separate account allowance. You would complete the application to purchase public service and acknowledgement of public service buyback form, also found on the LACERS website. So that is another option there. Government service buyback program allows current active members to purchase service credit for periods of full-time service with other governmental entities or uncompensated maternity leave with the city of LA. So maybe you worked for the city of Santa Monica for a year and you were entry-level clerical there. Then you decided to come work for the city maybe 5 years later, and you worked for us for the rest of your career. You can buy that 1 year from the city of Santa Monica because you had worked full-time there. So that's an example there, or you can buy time. Uncompensated maternity leave, maybe you had no sick or vacation and you had a child, and maybe at the beginning of your city career where you didn't have enough sick and vacation time. If it was more than 1 month of uncompensated time due to the maternity leave, you can buy that time back. So the important thing to note in these things is if you are not paid for a pay period anytime, whether you take a leave of absence and have not paid at all for a pay period, if there wasn't enough in your pay period to get 11% of your salary put towards retirement, then you didn't get credit for that pay period. So in this sample here, uncompensated maternity leave for at least 1 month, you weren't compensated, you didn't get credit for retirement that time, so you can buy that back later. Who's eligible? All of these are active members of LACERS, so you can't go back in retirement and apply for these things later. You have to do it while you're working. So that's the moral of this. Have at least 6 months of uninterrupted full-time service. So if you were a student worker with the city of Santa Monica, that wasn't full-time, and maybe it was just for a summer, that's not 6 months. So that's not buybackable. It has to be full-time at least 6 months in these other entities. Or, like I said, at least a whole month, maximum of 12 months. And you would complete a certification of service form found on our website. All right, so applying for these credit purchases. So you want to explore service credit purchases early to allow for processing time. Processing time for purchase credits take normally at least 6 months. And I say at least because sometimes they take closer to a year. So these are long processes. There's a lot to a service credit purchase, and depending on how complicated your purchase is, whether or not our service credit purchase unit needs to contact other government entities and get information from them, and how timely that information is provided back to them can really affect how long these purchases are going to take to give you, processing time. So it's very important to explore these early. Additionally, you must pay your contract off prior to your retirement effective date. So if you do a service credit purchase, you can pay it in one lump sum, or you can make payments to it. So if you choose the payment option, you have to finish paying it off before you retire. You cannot use your retirement to pay for your purchase. You have to complete it ahead of time. So that's a very important thing to note. And additionally, only active city employees can purchase service credit. You can't go on a leave of 2 years absence to sail around the world and purchase service credit. You actually have to be working at the time. And for additional information, please speak to a buyback representatives of LACERS. So our 800 number, which we will have up here, you can call them or you can email us. So very important. Go on our website. All of our contact information is on lacers.org. So don't worry. And then if you're able to pull up these slides on our website, all the information will be on these slides too. So please, please, please explore these early. One other thing to note before I go on, actually, that's not on the slide here, is do it early, because as you get more raises and promotions during your city career, the cost of these purchases will go up. So when you apply for a purchase, the current job that you are doing at the time and the salary rate that you're making is how it's going to be calculated. So even though it's not on this slide, that's something to very much consider. I know if I was eligible to buy something, which I'm not, because I've only worked for the city and then private industry and have had no leaves of absences, then I would have much preferred to use my clerk typist salary than my senior benefit analyst salary to calculate this purchase. So that's something that you'll want to look into and think about when you're considering applying for one of these purchases. And the easiest thing to do towards these purchases is fill out the application. That is the very simple. The applications are simple. It's just the wait time that takes time. So filling out the application doesn't mean you're married to the idea that you have to buy. It's just getting you started to explore how much these things are going to cost. Everything costs different. So just really something to consider. Now, additionally here in reciprocity. So reciprocity is for those that worked in other certain California public retirement systems. So a lot of you, this wouldn't pertain to you, but if you did work somewhere else, this reciprocity option allows members some portability of benefits. You can move from one public employer to another within a specific time frame, allowing some portability, like I said, of retirement benefits. Now, those benefits from each system, the benefits of this is that you receive a retirement benefit from each system based on the service credit acquired with the agency and the benefit formula by the retirement system. So what that means is you get two checks. You get a check from LACERS and you get a check from the other entity that you worked for. Let's just say the city of Pasadena for this example. You worked the city of Pasadena and then you worked for the LACERS. You'll get two checks in retirement. Now, both retirement systems will calculate your benefit based on the highest salary you receive, regardless of what agency it was paid by. So if you worked entry-level clerical at Pasadena and you worked executive level with the city, the cool thing would be that your Pasadena retirement will be calculated with your executive salary. So you would get more. So that's one of the bonuses of being able to claim reciprocity. Now, there are different types of reciprocity. Most right now would be full reciprocity. That means you transferred on or after 1997, July 14th. Limited was prior to July 14th. Now, the rules are very important. You must meet all of these rules in order to claim reciprocity. So you must leave one system completely. So for the example of City Pasadena, you must quit and leave that government entity and move to another one within the 6-month period. So you cannot leave the city of Pasadena for 7 months and then start with LACERS and claim reciprocity. It has to be 6 months or less. You have to leave and then start. You must also leave all of your contributions and interest on deposit with each system. So you cannot pull any money out. And so that's important as well. You cannot touch any money. Then thirdly, apply for reciprocity and both retirement systems agree reciprocity exists. So there's an application for each system to apply for. And then retire from both systems on the same date. So that's also very important. You cannot retire from one entity on one day and then 3 months later retire from them and gain reciprocity. It has to be the same date. Very, very, very important there. So those are, things to consider if you work with another entity, is reciprocity. So retirement eligibility and allowance calculation. So let's go over that. Very important, how much money you're going to get in retirement. So normal service retirement is what most of us should be aiming for. That's what I'm aiming for. And so eligibility requirements to receive your full amount, your full allowance, are going to be either age 55 or older with at least 30 years of city service, age 60 or older with at least 10 years of continuous service, or age 70 or older. So I'm aiming for the first check mark there, age 55 or older with at least 30 years of city service. I started at age 24 and a half. So by the time I turn 55, I will have 30 and a half years of city service. So that's my goal and aim here, is to get that first mark. But some of you may not have started before 25, and therefore you won't have 30 when you turn 55. So then what you could do is wait until you're age 60, and then you have at least 10 years, then you'll be good there. And this is a full allowance, or age 70 or older. So let's go over, what that means. So additionally, say you started after age 25 and you got to age 55 and you're like, man, I'm ready to retire now, but I'm not eligible for the full allowance. Can I still retire? Yes, you can. That's under reduced allowance. So if you're age 55 or older and you don't have at least 30 years yet, but you have at least 10 years, you can retire early. And that's for a lesser amount because you're retiring early. Or you started really young. Maybe you started right out of high school. You're age 18. You're younger than 55, and you have at least 30 years of service. Can you retire? Yes, and that's under reduced allowance again. So say you were 18, now you're 48, and you're like, I am done. I want to, I'm just done with the city. I'm ready to retire. I want to go. Sure, you can do that, but that's going to cost you. It's going to be reduced allowance. So let's go over a couple of things. Well, let me read the asterisk, the second asterisk here. So no health subsidy until age 55. Nathan's going to go over that in his section. So very important if you're thinking of leaving early, if you're not age 55 yet, there's some consequences to how much will go to your health. So very important to think about that. So 55, 30, 60, 10, age 70 is regular, full allowance. Or if you want to retire early, that's going to be 55 at least 10, or under 55 with at least 30. Remember, these slides are available for you to pull off of the website if you don't already have them yet, so you don't have to memorize it. Just know those are the allowance. Also in the summary plan description, so different places to view. So to calculate your allowance, you're like at the beginning I said there's a formula. Well, here's the formula. So to calculate how much money you're going to get in retirement, you're going to need a few things. You're going to need your final compensation, your total service credit, LACERS retirement factor of 2.16%. And if you're leaving early, you're going to need that reduction factor for your age. So that's very important. So those of you that may consider leaving early, this is important. Your age is a huge factor in early retirement calculations. So let's go over final compensation first. So final compensation is the monthly average of the highest 12 months of compensation you earned by your classification. So that includes your base salary and most regularly assigned bonuses and premium pay. So very important, base salary and regularly assigned premiums and bonuses. That's what's included. So say things that are not included. Overtime. So overtime, you don't pay 11% of your overtime pay in a retirement. Therefore, you don't get credit. You pay 11% of your base salary and regularly assigned bonuses into your overtime. So overtime is not part of your final compensation. Neither is daily or non-regularly assigned bonuses. Those are temporary bonuses. So things like acting pay, that's temporary. You don't pay 11% of your acting pay into retirement. So things like that, that's not included in your final compensation. Reimbursements, maybe you went to school and got tuition reimbursement, and maybe, I don't know, some departments provide that, or other reimbursements. That's not calculated in your retirement. Neither is car or uniform allowances, payment in lieu of benefits. Acting pay has its own bullet at the bottom. So all of those are not included. So it's your base salary and most regularly assigned bonuses and premium pay. Something like a graveyard shift. You're assigned a graveyard shift, that's a regularly assigned bonus. Stuff like that. If you're not sure if your bonus is calculated into retirement, ask your HR, your personnel section. They'll be able to help you, or your union. It would be in your MOU document. So those are two places you can check to see if your bonuses are part of your final compensation. So once you get your final compensation, you're going to multiply it by your service credit, which you are able to find on your MyLACERS statements that you have. So very important that you have a MyLACERS account. Then you'll know exactly what your service credit is. It's updated every pay period, because remember, you get 0.0385, something like that, a little bit every pay period towards your retirement. So your service credit that you're going to have when you retire, and then your retirement factor of 2.16%, and that's for every tier 1 employee, whether it's early or normal. And if you're leaving early, also that retirement reduction factor for your age, that's going to equal your retirement allowance. So here's reduction factors for age. And these are just from, this is not the full list. It goes in quarter years all the way from like age 45 to 59 3/4. So these are just samples that fit on the page. So if you're thinking of leaving early, you can go on our summary plan description and on our website, and you'll see the full table. But just an example here, you started at age 21 and you're ready to go at age 51. You got 30 years. You're like, I'm done. I want to retire now. I'm leaving. Early retirement is good for me. Well, you want to take a look at that reduction factor before you sign on the dotted line. The reduction factor is 0.8050. That's 19.5% less you're going to get in retirement than if you would have waited till you were normal retirement age. 19.5%. That's pretty big. And that's lifetime reduction. You don't get more when you reach a certain age. So that's something to consider too. If you are leaving early, please consider the reduction factor before making your final decision. For some people, it doesn't matter. They're ready to go and they want what they're currently entitled to, and that's perfectly fine too. We give you options. So that's, that's your choice. You will notice that as you get closer to age 60, the reduction factor gets lower and lower. So, age 59, that's what, 8.5%, 7.5%, 55. Age 56, it's down to 6% reduction factor. So age 56, 6%. Age 51, 19.5, big difference. The reason why we have age 55 to up to 60, which is because for those that don't have the full 30 years when they reach age 55, they aren't eligible for a normal retirement because they don't have the 30. So we find a lot of people leave in that age factor there. Between 50 and 59, some people decide to retire even though they don't have the full 30 years yet. And that's because the reduction factor is very modest. My predecessor that used to work and did the seminars years ago, he left with about 18 years and he was around age 57, 58. So he was, somewhere in between these. So he probably took maybe 3% reduction. So that he was ready to retire at that age and 3% was okay with him. So just think about it if you're considering leaving early and look at the reduction factors. Now here's in the formula. So we're gonna have a normal formula on the left and an early formula on the right. So normal service retirement, this person's 65, they make $4,000 a month while working. They worked 20.25 years and they have 2.16 retirement factors. So they're gonna make $17.49.60 in retirement a month. Now for the early person, the only difference here is they're age 55 and they're, they're not old enough with just 20.25 years. So they have to include that reduction factor of 0.9250. This person is only going to make $16.1838. a month. So that's a big difference there, about $120, $130 difference a month. So just something to consider when you're making your decision in your retirement, on your retirement, is if you're okay with early, and if so, are you okay with the reduction factor for the age you choose, or for normal? You can go above 30, you can go to 42 and a quarter or something like that, and you will get to 100%. So, you know, something to look at here is you're making $4,000 a month while working, but with only 20 and a quarter years, you're making a little less than half. So that's just something to consider. You want to mentally prepare for, you know, your choice of when you're ready to retire. And we'll go over how this number could look, you know, a little bit better, closer to 4,000 later on in the presentation, but just things to think about when considering retirement. Let's go over final compensation percentage. Now for each full year of service credit, you earn the 2.16% of your salary. So with 30 years, which is what I'm aiming for, technically 30 and a half, but I'll just say 30 years. If I work 30 years and retire, I'm going to multiply that by the retirement factor, 2.16%, and that's going to equal 64.8% of final compensation. So for someone that retires with a regular allowance at exactly 30 years, you're missing about 35% of your salary that you get normally while working. So that's how you calculate that. As I mentioned just a slide ago, if you go all the way up to 42 and a quarter-ish years, that's when it equals 100. So 42 is the magic number for those of you that want to equal 100% of your salary. Just know that you cannot go over 100%. You cannot go to 102, 104, 108. So those of you that work more than 42 and a quarter years are kind of working for free. But you know, it's everyone's choice, because even my dad works in private industry. He's almost 69. He's been working 40 something years. He can have retired years ago, but he chooses not to because he gets overtime, and he loves the overtime, and he won't get the overtime in retirement. So, I mean, everybody's different. So when you're ready, and you know, but you know, it's your choice. So increasing your monthly allowance. So there are 3 variables that impact your monthly retirement allowance. That's the timing of your retirement. So when you choose normal versus early, service credit. The more service credit you have, the closer to 42 and a quarter-ish years, that's the, you know, the more money you have. And then final compensation. So how much money you make per month while working. So remember that for final compensation, it's the highest 12 months of your salary ever in your career. For most people, it's the last 12 months of you working, because you've had your most promotions by then, your most COLAs, you're at the highest step. So that's where you'll have the highest final compensation. For some people, it may be a little bit earlier. Maybe you want an emergency appointment for a year to an executive position, and then you drop back down off that emergency and then never went back up. If that was your highest year, highest 12 months ever, then we'll use that for your final compensation. For some people, they, you know, they're just choose to have a different class. When I worked at LAWA, there was a secretary that was just wanted to ease out of her position before she retired. She reverted down to senior clerk typist to have less work in her final year. So obviously a secretary made more. So her final compensation was probably her last 12 months as a secretary. And then as a senior clerk typist, she made a little less during her final year. So that was her choice. She reverted to a lower position. So whenever you have the highest consecutive 12 months, so just something to think about for people that are thinking, oh, I'm going to get a raise in January, so I want to retire right in January when I get my raise, like right after. Well, that's great if you want to retire, you know, a week after you get your raise, but you only got 1 week of that 12 months at the higher raise. So really, you got to work that whole year to get that whole COLA calculated into your, you know, your final compensation. So just something to consider is the highest 12 months. And that's how we calculate it. Some people ask about, well, I'm going to be furloughed. How will that affect my retirement then? Well, when you're furloughed, or maybe you choose to work a 72-hour work week, we have those as well that you're approved for a 72-hour pay period. You can work a 72-hour pay period. We're still going to take 11% of your salary as if you were working a full 80-hour pay period and put it in retirement, so you are not penalized. So that's also something to think about too, is that a 72-hour work pay period will not affect your final compensation calculation. We will still calculate you at the higher level. All right, benefit estimates. So I've mentioned MyLACERS more than once already, but I'm going to mention it another time here because MyLACERS is a really cool, helpful tool for you as you're planning for retirement and then additionally in retirement. So estimating a benefit. For the 50% of you that are thinking you're retiring probably in the next 6 months or so, you can estimate what you're going to get on your MyLACERS account. You just need to go in to the estimated benefits slide menu on the left, and then put in the dates. And it already knows your age. It knows all your information. It knows what you're making. So it knows what you're currently making. So if you try to put in a benefit estimate for yourself and you're not planning to retire for 10 more years, the system's not going to know how many promotions you're going to get. So it's going to estimate on what you're currently getting. So just something to think about. But for those that are getting really close, this is going to be a very good estimate because it's probably not going to change that much. You put your separation date. So usually that's the last day of the pay period, and retirement date the next day. And then you calculate and you get an estimate right there. So that's a very helpful tool for those of you nearing retirement, or if you're just considering retiring in the next few years. Maybe you're going to be getting ready for early retirement and you want to see the differences. So you're in your early 50s and you want to see, well, what if I retire at age 55 or if I wait to age 57? You can estimate your benefit as many times as you want here and just put, all kinds of different dates and it'll estimate it for you. So it's a cool tool to have and to use. So please, please, please check that out on your own. It's self-service, so very easy to do. All right, disability retirement. We have one slide on disability retirement, and that's because a lot of people get disability retirement confused. So with disability retirement, you need to have at least 5 years of service. But the one thing about it is it's generally 1/3 of your final compensation. So if you were retired normally, you would get 100% of your you would get your final compensation calculated in normally. But for disability retirement, it's 1/3. So people confuse that, thinking, oh, I'm disabled, I need to get a disability retirement. You don't necessarily need to retire on a disability retirement just because you were disabled, because a normal retirement may be much better for you. Now, a disabling condition doesn't have to be job related, but it must prevent you from performing your regular duties. And you must file for a disability retirement within 1 year of your last day on active payroll. If you do not apply in time, you lose your eligibility for this benefit. So if you have any coworkers or family friends that work for the city that have something preventing them from working, a disability, please send them over to LACERS to talk to us. We have a disability retirement section where about 4 or 5 LACERS staff members do just disability retirements, and they can talk to this person or whoever needs the information if they're disabled to let them know whether or not they should apply for a disability retirement, or if they're eligible for a regular retirement or an early retirement, and talk about all the nuances of applying for them. So with the asterisks at the bottom, it says if you have more than 15.4 years of service credit and are eligible for normal retirement, it may be larger than a disability retirement allowance. So something to very much consider. If you are disabled, you cannot work, just talk to LACERS. They're going to recommend what's best for you. We have your best interests in mind. We're not going to say, oh, you'll make less, let's get this person on less. No, we're going to give you what's the best for you. So please just contact us. All right, so let's go over retirement benefits on this next slide. This is retirement contributions, and we have an example employee/retiree named Angelina. Her salary when she chooses to retire is $65,000. Her service credit is 26 years. She's age 60. She contributed $80,000 over her lifetime as working for the city. So contributions, those are how much money you put into the system. So like I said, right now we're putting 11% of our salary in. So 11% of Angelina's salary went in over those 26 years to equal $80,000. That's what that means. So the retirement allowance, and this may not be exactly right, this is an example, is $36,500 a year. So that's how much she's making with the formula that was used. And then we have the three colors. We have the employee contributions, we have the city contributions, and the investment returns. At the beginning of this presentation, I talked about the three ways that the funds were funded. Those are the three ways. So the only thing that's finite is your contributions. When you retire, there's an exact amount as to what you put into the system. Your 11% of your salary throughout your entire city career into the system, and that is that number. So that's the purple. So that's the only finite amount. So the way that your paycheck or your benefit allowance, your monthly pension, whatever you want to call it, is paid every month is these three ways. So it's funded by the three things. So at age 60, she retires here on this graph, and she goes a little bit past age 72, 73-ish, 71, something like that. And then her purple bar ends. That's her contributions. We ran out of funding her for that. So are we going to stop paying her after that? No, we agreed to pay her the full amount, whatever the formula was, when she retired for the rest of her life. So that means the investment returns and the city contributions kick in to make sure she's fully funded until she passes away at age 82. So why does that even matter to you? Well, let's go over that in the next couple slides. And that's your retirement option selections. This is something you're going to have to select when you fill out your retirement paperwork, and it's irrevocable once your retirement date passes. There's two options here. The first one is cash refund annuity. With cash refund annuity, if you select that, after your death and the death of your spouse or domestic partner who receives a continuance, a lifetime benefit, which we will discuss a little bit later, your designated beneficiaries will receive what's left of your unused contributions. So let's go back 2 slides to look at cash refund annuity. All right, so here's the purple. So let's say Angelina dies. Angelina retires at 60 and then she dies at 63. And she had a spouse that also died with her. I don't know, they just perished. We'll just say they're gone. So she passes away with her spouse at age 63. Well, she picked cash refund annuity. So what's going to happen with this purple bar all the way up to 72, 73-ish? There was money there. She had paid that 11% of her salary her whole city career. She was entitled to that money. So what happens to it? Her and her spouse are gone. Well, if she picked cash refund annuity, whatever that amount is will go to her beneficiaries, whoever's left, after her spouse. Maybe she has children or nieces, nephews, sibling, whoever. That a one-time check payment will be paid to them. That's cash refund annuity. Now let's go and talk about the next one, life annuity. So if you select life annuity when you retire, after your death and the death of your spouse or domestic partner receiving a continuance, what's left of your unused contributions will not go to a beneficiary. Very important here, not go to a beneficiary. The increase you received when selecting this option does not provide you the right to leave any unused contributions to a beneficiary. So if you pick life annuity, then you get a little bit more money in retirement every month. And it'll be calculated. Your retirement counselor will let you know exactly what that is before you make the decision. They will provide you with all the information to make your educated decision before you sign on the dotted line between cash refund annuity or life annuities but you will receive a little bit more every month. It's not a lot. I don't know if it's like $50, $100, $20. It's something small, but it is more money. So some people pick it. But say you selected life annuity. If we go back to slides, and Angelina, same thing happens. Her and her spouse perished at the age of 63. So neither one survived it. So there wasn't anybody to collect the money. Life annuity had been selected. So all this money goes back into the LACERS Pension Trust Fund. It doesn't get paid out to a beneficiary because life annuity was selected. Angelina picked to get more money on her LACERS monthly allowance every month while she was alive, her and her spouse. So that's the difference. Now, you know, it's totally up to you. People pick. I don't know if anyone picks something, you know, more than the other, maybe 50-50, I'm not sure, but it's really up to you. Some people are like, well, you know, here's the line here. If I outlive my contributions, then life annuity may have been a better choice because I get paid that little extra money all the way till I pass away. So if Angelina had picked life annuity, she would have gotten paid extra money all the way till her, you know, when she passed in age 82. But, you know, some people, they have health conditions, they know they're not going to make it past that line. And that line, that date will be told to you when you make that educated decision at retirement. Your retirement counselor will say, your contributions will end on this day and this year. So you will know exactly what day and what year you need to outlive if you pick life annuity. But you just never know. Like we've had an example where someone perished in a car crash a month after they died, and I mean, a month after they retired, and they did not get paid. So nobody got paid because life annuity was chosen. So you don't know. You don't know, you know, what's going to happen to you. No one knows exactly when they're going to pass away unless you actually do. But, you know, that's my Disney dry humor, sorry. But it's just a decision you have to make. You know, if you pick life annuity, you got to outlive that line in order for it to have been a better choice. And if you have a spouse or domestic partner, that, you know, is both of you outliving that, because if you pass away and they still outlive it, and you know, they get a portion of your retirement, which we'll go over. So just a decision to make. I noticed that someone tried to raise their hand. Just remember you have to put the question and answer, type it in, and Nathan will answer your questions. But you aren't able to speak verbally on the question on this webinar here. So please type in your question and Nathan will take a look at it. Okay, so those are the choices. So remember, cash refund annuity, if you pass away and your spouse also does, then a designated beneficiary will get what's left if there's anything left. If you pick a life annuity, you get more money while you're living. But if you did not outlive that line, which your retirement counselor will tell you what that line is, that date in the sand, then you know, those whatever was left won't go to your beneficiaries. It will go to their LACERS Pension Trust Fund. So just a decision you have to make in retirement. And you know, you'll be filling out a lot of forms, but this is one that's important that you need to learn just so you understand. So there's that. And it's, once again, irrevocable once your retirement date passes. Continuance benefit. So I mentioned continuance a few times on the last slide. So what is a continuance? Well, a continuance is a lifetime monthly benefit provided to a qualified beneficiary as a result of a death of a retired member. So a portion of your retirement contributions, called survivor contributions, is set aside to provide a 50% lifetime monthly continuance benefit to your eligible spouse or domestic partner. So continuance is good for your spouse or domestic partner should they match, should they qualify. And you may provide a larger continuance, but a lifetime actuarial reduction will be applied. So basics here, when you retire, I think on the next slide, yeah. So when you retire, if you're eligible and you pass away first, your spouse or domestic partner will automatically get 50% of what you were making. So say you make $4,000 a month in retirement, you pass away, your spouse or domestic partner outlives you, they start making $2,000 a month for the rest of their life. So it's automatic 50% minimum. No cost to you. It's no cost to you in retirement. It doesn't cost you anything for the 50%. But if you think your spouse or domestic partner cannot live on 50% of your retirement, then you can up that amount. You can up it to 75%. You could up it to 100%. It is your choice, but it's going to cost you some money in your retirement. And it's going to be actuarial. So it depends on how old your spouse or domestic partner is at the time of retirement. They'll use an actuarial accounting to determine that amount, and they will let you know. So you can leave more than 50%, but you do have to select that prior to retirement. You cannot select 5 years into retirement, say, oh no, I think I'm gonna go first. My spouse needs money. I gotta up it. No, you can't change your mind then. You have to decide at the point of retirement. So before, when you're signing all that paperwork, this is one of the choices. So please look into that. Now, an eligible spouse or domestic partner here on this next slide is very important. In order to be eligible to receive the continuance, so the spouse or domestic partner outlives you, they have to meet these three things. First one, you are legally married and a LACERS, legally married or in a LACERS or state registered domestic partnership at least 1 year before retiring. So you cannot retire and then marry and then they receive a continuance. You have to marry them or fill out the domestic partnership paperwork a minimum of 1 year before your retirement date. Number one. Number two, you are legally married or in a LACERS/state registered domestic partnership when you retire. So at least 1 year prior, same person on the date of retirement. And then three, you are legally married or in a LACERS state registered domestic partnership on the date of your death to the same person. It cannot be one person, a new person, and a new person. Same person, all three. So those are three very important things. So you're more than welcome to get married in retirement to a new person, but they will not be an eligible spouse or domestic partner in retirement for a continuance benefits. They will only be eligible to receive health benefits, and Nathan will talk about those later while you're alive. But they will not receive a lifetime benefit should you pass first if you marry them after retirement. It's very important that you are married or domestic partners at least 1 year before retirement. So just something to think about for those of you that are considering retiring soon and may or not be married or domestic partnership at the moment, but want to be and have this person that you're thinking of have an option to have a lifetime continuance. You need to have that at least 1 year in before your date of retirement. So think about that. All right, single member options. So you're single when you retire, not married, no domestic partnership. So you have a couple of options because there's no continuance that we're funding. So there's going to be a lump sum cash payment that you could take. Your retirement counselor will tell you how much it is, or you can apply those contributions that have been used to fund that 50% continuance, which you aren't using, to increase your actual retirement allowance. So that's pretty cool. You get, a check, or you can increase your retirement allowance. So you'll be given those two calculations from your retirement counselors to choose from. So that's pretty cool. And then additionally, there is this option as well. Single members may leave a continuance benefit to other persons, but a lifetime actuarial reduction will be applied. So sometimes we get the single, you're single and you're ready to retire, and you love your niece and she's 10 years old and she's like the best thing since sliced bread, and you want to make sure she's taken care of, when you pass, because she's going to outlive you. Well, you can leave a continuance to another person if you're not married and do not have a state registered or domestic partner, but that lifetime actuarial reduction is going to really cost you. The 10-year-old niece, she's expected to outlive you by quite a bit. She's only 10. So that's going to be a pretty big chunk of money, but it is an option. Some people want to do that. Maybe you have a child that you want to leave it to and you're single and you don't plan on having a spouse and you want that child to receive a lifetime continuance, you can do that, but it's going to cost you, and it's going to be that actuarial calculation. So it is an option. In previous seminars we've been asked, can if I'm married, can I leave it to someone else? No. If you're married and you have to leave it to your spouse. So just something to think about. This is only an option for single members at the point of retirement. All right, continuance elections. So continuance elections are irrevocable once you retire. If the individual you designate for a continuance dies before you, you cannot name a new person to receive a continuance. So if you outlive your spouse, you cannot marry a new spouse and then give them the continuance. It's that one person, one spouse or domestic partner. No continuance payment will be made upon your death, and your retirement allowance will not be increased. So say you thought you were going to pass away first, so you upped your spouse's above 50%, you paid extra, you paid for the 100%. She's like, I'm sure I'm going to pass away. I'm going to go first. But then you don't, and your spouse passes away. You can't take that back. There's no calculation that's going to say, oh, I'm sorry, they passed away, so we're going to give you money back. No, it's you have to make that decision when you retire on how much money you're going to put, if you're going to just do the 50 or the 75, 100 and whatnot. So just something to think about. Your decisions are irrevocable. So a lot of irrevocable decisions, once that retirement date passes. So just something to think about. All right, taxes, Social Security, and COLAs. So what I'm going to do right now, because we've been talking for about an hour and 20-ish minutes, we're going to take a 2-minute stretch break. So I'm going to turn myself on mute, and I want everybody to stretch and maybe get a glass of water for 2 minutes, and then we'll come back in and we'll talk about taxes, Social Security, and COLAs. So please take that 2-minute stretch break. I'll be back in about 2 minutes, and then we'll go for about 20 more slides, and then we'll bring Steve in to talk about Voya. So see you in 2 minutes. All right. Hope everyone was able to stretch for a few minutes. We're going to go ahead and start back in with taxes, Social Security, and COLA. So some very important 3 topics here. So let's talk about taxes first. So retirement allowance, that is taxable. So Ben Franklin once said, but in this world, nothing can be said to be certain except death and taxes. So once again, your retirement allowance is taxable as income. We have a website down here at the bottom of the page, retirementliving.com/taxes by state. If you're thinking of retiring to another state, please check out this website. It's pretty handy. It tells you different taxes in different states. I believe there's about 7 states that don't have income tax. So for example, Alaska, you can move to Alaska and not pay state income tax. I believe maybe Montana, Nevada. Nevada is definitely one of those states that doesn't charge income tax, but they always get you in some way. There's always different taxes somewhere, or for the case of Nevada, they have casinos that will take your money that way. So, check out other states and what their taxes are. I know Oregon has pretty high property tax, but they don't have sales tax. So you could buy as much as you want in Oregon, not paying any taxes. But if you own property, you pay more property. California is a high tax state. New York is a high tax state. So it really just depends on where you want to, live in retirement. But, it's important to learn what kind of, what taxes are in each state. We all know what California is because we've been living here, most of us for a while. And so we know what California taxes are. But, if you're going to move to another state, check out what their taxes are and before you decide to move. And then Nathan will talk a little bit later about health benefits, and each state has different options for health. So that's also something to consider when picking a state to live in retirement. Important to know that federal tax, you can't escape that. So you can escape state tax by going to another state that doesn't have it, income tax, or moving out of the country, you don't have to pay state income tax if you don't live in a state, but you're always going to have to pay your federal taxes because you're getting paid from LACERS, which is a government entity. You're getting paid from the United States, basically. You know, you're getting paid here. So Uncle Sam wants his taxes. So there's going to be that. But just know there's different taxes in different states for different things. So that's enough on taxes. One thing to note before we go into COLAs is I didn't mention earlier, there is a survey on our website, and we'll also send you a link at the end of the seminar today. We'll email you a link to the survey, but if you're ever interested in providing feedback to LACERS, either for this seminar or for a customer service experience, which is either positive or negative, because we want to know both, please check out our survey. It's on the footer at the bottom of lacers.org, and it's our customer service survey. You can, do a shout out for a great employee that you met that helped you at LACERS, and you can, put their name in, or you could say, I went to this seminar on September 29th, and Heather was amazing, stuff like that. But you can do that. So that's always an option. Or if you call in, you had, a good experience or a bad experience, just let us know on that survey. So once again, lacers.org, at the bottom of the page on the footers is an option to take that survey, but we'll send you a link later. Just want to let you know now. I tried out this 2-minute stretch break today. Hope that it got you all rejuvenated to, come back and learn more instead of just sitting at the computer for hours. So, let me know on that survey when you take it, if you like the 2-minute stretch break, stuff like that. But let's go ahead and get into cost of living adjustments, or COLAs. So our COLAs in retirement are all the same for everybody. Right now, while working, we all get different COLAs depending on our job classification, which union we work, we belong to. Our unions negotiate our COLAs right now. So everyone gets a different COLA at a different time, depending on, what job classification, what union. In retirement, everyone is a retired city employee. You are no longer in the job classification. You are a retired city employee, so everyone gets the same COLA every year. And that's based on the Consumer Price Index, the CPI, for the Los Angeles area. So even if you move to Hawaii, we're still going to base that Consumer Price Index calculation on the Los Angeles area, because that's where City of Los Angeles, LACERS, is located. So CPI here in LA may increase your retirement allowance a maximum of 3% per year. Maximum of 3%. Excess CPI over 3% is banked for future years. So what does that mean? Excess CPI over 3% banked for future years. Well, I have an example here on this next page. It's a little large. We used to have a smaller graph, but this one, kind of example here. So I'll try to show you here. But this is just some historical data about our COLAs. So it looks like it goes from 2009 to 2017. And I think the idea here when we created this slide was to show an example of when the COLA was more than 3%. So actually recently it was more than 3%. So I want to say this past year or the year before, it was a little over 3%. So people got some money banked. So basically the CPI in the LA area, let's just go to an example here, 7/1/17. So you get a COLA once a year. You don't get twice a year, every other year. It's calculated every year, and it takes effect on July 1 of every year. So on your July paycheck, you'll get the higher rate. It's negotiated in the spring. So remember that we are, we have a board of administration here at LACERS. The board will vote on that COLA in the springtime. It'll be, listed in our minutes. You can listen in if you choose, if you're so interested. But every spring, we'll determine the COLA for the July, the new fiscal year. So July 1, 7/17, the CPI in the LA area was 1.9%. Therefore, the board approved 1.9%. The max COLA is always 3%. So that's 1.1% that was not used. So, everyone got 1.9%. So let's go down to 7/1/2009. The CPI in the LA area was 3.5%. So the approved COLA was 3.0 because the maximum for the LA Administrative Code is 3.0. We can't go above 3. So we gave 3. but 0.5% we weren't able to use. The CPI in the LA was 3.5. So we put 0.5% in the bank. So anyone that was retired for that full year prior to July 1, 2009 got 0.5% banked for future use there. And it looks like the next year probably was used because we got negative. So negative there. So you got 0%. So I think the last time we actually had a 0% COLA was 10 years ago. I guess that's kind of a bottom market then. So 0%. So we'll see what the next few years holds depending on the COVID situation. I know this past July 1, they actually did get a COLA. It wasn't negative or 0. So that was good for our retirees. But, you know, if it's at 0, we're not going to take the money away from you. You just won't get, you know, any extra that year. So the key things to know is you have to be retired for the entire year to get the full COLA. If for those of you that are retiring in this upcoming year, you know, there were a lot of you that said in the next 6 months or so, we do an average out. So we do a percentage of it. So say you retire in February. So for every whole month that you retired before July 1, you're going to get a portion of that. So you would do March, April, May, and June. So 4 months. So you get four out of 12. So 1/3. Yeah, 1/3. I had to do my math in my head there. 1/3 of the COLA for that year. So say next year, the example could, let's just say it's 1% next July, you would get 1/3 of that 1% because you were only retired 4 full months before July 1, if that makes sense. So it's a portion. And so, you know, you get a COLA every year, once a year, everyone gets the same. You're not going to take money away from you. And if it's more than 3%, it's banked for a future year. And it'll be used in any year that's less than 3. So you can't get any money banked if you weren't retired. So you had to be retired the full year in order to get that bank percentage. So those are our COLAs. So it's pretty cool to get COLAs in retirement because cost of living, especially in Los Angeles, it always seems to be going up. So it's nice to know that we in retirement will also be getting paid more and more every year. So pretty cool. All right, we have a slide on Social Security, and that's because some people are eligible for Social Security in retirement because of other jobs that they worked. We as city employees do not pay into Social Security, and we do not, we will not get Social Security benefit in retirement. So if your one and only job was City of Los Angeles, then you will not be eligible for Social Security because you do not pay into Social Security as a city employee. For example, I work in the private industry. I worked 19 years for Walt Disney Company. So I pay into Social Security whenever I work for them. So I'll be eligible for a small amount of Social Security in retirement, but there are some nuances to that. And let me read over a brief information here. And then if this also pertains to you, then please, do your research on that when you're looking to retire and reaching Social Security age. So if you receive a Social Security retirement benefit, the federal government may reduce it because of your LACERS retirement allowance. And that may trigger one of the following. The first one is the windfall elimination provision. It impacts you as the member. So if you receive Social Security and you also receive your pension, you're going to have the windfall elimination provision impact you as the member with your Social Security account. And there's this long website here that you'll want to go to. I'm not going to read it out because it's a long, little document here, but you can either copy that down or pull up these slides from our website. Because remember, all of these slides are on the website for you to pull under our seminar section. So you don't, you can click on the link there. Or you could just Google windfall elimination provision and make sure it takes you to an official ssa.gov website so it gets you the proper information. But basically, you're going to get less money from Social Security because of your government pension, your LACERS benefit. So that's going to affect me. That's why I say I'll get a little bit of money because of my Disney job when I'm, when I reach that age, but I'm not going to get the full amount if that had been my only job. But I'm very grateful for my pension because that's going to pay me a whole lot more than Social Security would have. So just know that this impacts you if you also had a job such as I in the private sector. Now, the second one, government pension offset, impacts your surviving spouse. So this goes into effect if your surviving spouse actually had a private industry job where they're receiving Social Security. So it doesn't impact your spouse at all that you have a LACERS retirement allowance ever, unless they outlive you. Once you pass away, they are going to start be receiving your government pension when you pass away because of that continuance benefit we just talked about. And at that point, they now receive the LACERS pension, government pension. So their Social Security that they were making will be affected. And that's going to be, you know, here on this little website thing. So if basically, you know, we don't have really any more information than that because we don't provide Social Security here at LACERS, but it's just something that we want everyone to know about and to look into, because if you did have a private industry job or another job elsewhere where you're entitled to Social Security, you want to, want to know ahead of time these things. So people ask too about the windfall elimination provision. I've had this question come up in previous seminars is, you know, well, what if I want to take my Social Security early? I'm in my 60s now and I haven't retired from the city yet. Can I take my Social Security now? Will this affect me? And from the looks of it, if you take Social Security while you're still working for the city, you're not receiving a government pension yet. So you'll get the full amount if you take your Social Security and then still working for the city. But at the point in which you do retire and start getting that pension, that's when the windfall elimination provision kicks in. So just something to think about too as well. But you'll definitely have to contact Social Security for more details and more information. Please either look up these exact, pamphlet flyers on this slide and or Google them and take yourself to ssa.gov. You do a search on that website as well, but please, look into that if it pertains to you. It pertains to me, it sucks because I'm like, well, I worked 19 years already for this place, private industry, and I'm going to get less, but, I'm still thankful that I'm getting, the government pension. Much rather have a LACERS retirement than a Social Security benefit. So, but just something to think about, something to research. All right, let's go over supplementing your LACERS benefit. So, supplementing your income, your LACERS retirement allowance. Well, it should be considered the foundation of your retirement financial planning, but it may or may not cover all of your expected retirement expenses. Remember about 20 slides or so ago, we showed how if you work 30 years, you only get about 64.8% to final compensation. So how are you going to make up that 100 if you need 100%? You want to think about those things. So let's just take a look at a sample of a city pay stub here real quick. Just look at things that are on here. And we got some stuff in red. So we got retirement, and that's kind of like three little things. It gets a little complicated, but it equals 11%. So you got retirement health deferral, ERIP recovery. That all equals 100%. And we're paying ERIP recovery for, another 10 years or so. It's in your MOU if you're curious. But yeah, we're paying 1%. That equals 10% plus 1 equals 11. So these three things equal 11% of your base salary. Then you got 1.5% FICA Medicare. So we're paying into that. Anyone after April 1st, 1986 pays that. Anyone that started after that date with the city. Nathan will go over, what that is during her health presentation. And then we have 4% deferred comp. So Steve's going to come on and about 10 slides or so and talk about deferred comp, but a lot of us choose to pay into deferred comp. I'm paying a lot into deferred comp right now, just to, make sure I have a decent account. So the sample here is 4%. It's, whatever you make it, you can do 0%, not paying it to it, or you can pay, a lot. There's, limits Steve will talk about, but deferred comp is an option. City parking, well, I was paying for that until, COVID happened, but so 25, 30-ish, so about 1%. So, some people are at home, some people are working, some pay for parking. I was paying for a van pool before that. So, there's commuting expenses, 1%. And then union dues, a lot of us pay union dues. We'll just say it's 0.5%, but it's different for everyone in their union. So if you add those all up, oops, I guess it's not on there. So if you add those all up, that's a lot of money. Now, do you think that these are all going to be deductions when you retire on your retiree pay stub, on your retirement benefits? The answer is no, it's not. So when you think about it, there's a lot of deductions on your current pay stub while working for the city that's not going to be a deduction on your retirement. Your retirement allowance that you get once you retire. So even if you just forget all these other ones right here, the little ones here, even if you just cut the 11%, as soon as you retire, you're not going to pay yourself into retirement. There's immediately right after your last day of work and you retire the next day, you are no longer paying that 11% out of your paycheck every 2 weeks to put towards retirement. So that's 11% less just with that alone. Then the FICA Medicare, the deferred comp, I mean, that gets close to like 17, 18% less. So when you think about it, if you work 30 years, that's 64.8% of final compensation. But then if you add another 18 or so percent just by retiring, because you're not paying for city parking anymore, you're not paying van pool. Union dues is optional in retirement. You can certainly belong to a union if you choose to, but it's optional. Deferred comp stops when you retire. You cannot pay into deferred comp anymore. So that's not a deduction that's available to you. FICA Medicare also stops when you retire. So all of these things stop. So if you add 64 plus 18-ish, that's in the 80s. So 64, 82%. So now you're that much closer to 100. So, maybe you have a lot of money in deferred comp, maybe you've had some, other things, but that, a lot of options. So consider that you retire with 15 years, that's, 32%, 46.3, there's that 100%. I think I was saying 40, 42, something like that. So get to that 100%. There you go. So that's how you can get to your retirement. Now, larger annuity. This is another program that LACERS offers. So what is it? Well, it's an optional retirement or investment account that allows you to invest more money towards your retirement. I actually joined this about a year ago. It's just a basic form you fill out. It's on the LACERS website. I put like $25 a pay period into it. I think $25, the minimum, it's $25, $50, something like that. I pay in a large annuity program. It allows me to contribute post-tax monies on lump sum contributions or biweekly contributions, rollovers. You can roll over a Roth IRA, roll over some monies, but Roth IRA rollovers are not permitted apparently. You can invest, choose your investments. So you can, choose the 5-year treasury note, or pick the LACERS rate of return for publicly traded portions, and at the time of retirement, you convert those funds into a lifetime monthly annuity that would be in addition to your retirement allowance. So I was like, I'm 12 years in, why not? I add $25, $50 a month to this. So something I did, this past year. So if you're getting close to retiring in the next 6 months, probably not an option. Probably can't put too much money into it, but if you're retiring in a couple of years from now or even later than that, you may want to look into it because it's just another option to have more money at the retirement. And you just have to fill out the form and send it on over to us. So it's on our website, the large annuity program. Deferred comp. So I'm not going to say much about this because we have Steve coming on in about 10 minutes. And the deferred comp plan, I love the deferred comp plan. So I'll just say I put money into it every week or every pay period. I've taken a couple of loans out and, helped pay for a car and, house repairs. So, and, there's a lot of cool advantages to deferred comp. So I'm very much an advocate for deferred comp plan, and it's a total voluntary plan. Voya runs it right now, and it's a tax advantage governmental 457B plan that allows you to save pre-tax portions of your salary so you can enjoy it later in retirement. They also have a post-tax option that Steve will, I'm sure, will talk about. And you decide how much you want to save, how much you want to invest, and how to manage your taxes in retirement. So there's this website here, la457.com. And I will, you know, bring Steve on in about 10 minutes and he'll have a presentation for you then to talk about more on deferred comp. So stay tuned for that. All right, so next. So when you're ready to retire, let's talk about that. So this is more of the mental preparation section, just a few slides just to get you, you know, thinking about retirement. Most of us think about the money in retirement and how much free time you're going to get. Those are the two things that you think that many people think about. How much money am I going to get and how much more time I'm going to have available? But have you thought about anything else when planning for retirement? Sometimes people don't think about that till they're in retirement, then they get a little lost. So definition of retirement is withdrawal from one's occupation, business, or office. And there's different perceptions out there. Some are reward for a lifetime of hard work, end of regular employment or salary, isolation, loss, loneliness. So, you know, it's different for everybody. So retirement. So yesterday versus today. So you worked until infirmity and became dependent on your family. So it was seen as negative in the past. So retirement didn't really exist 200 years ago. You basically worked until you could work no more, was, you know, what retirement used to be. But now retirement today is seen as a more positive event, especially for those such as us who will be receiving a pension, will have security in retirement, will be taken care of money-wise. So it's, you know, freedom. Do you get to do what you want to do instead of what you had to do? And really, people are living longer in retirement too. You know, you could spend 10, 20, 30, or even more years in retirement. You know, once you retire from here in the city, so you want to prepare for the long haul. You want to, you know, mentally prepare for your new career of retirement. So a successful retirement is really a personal responsibility. You want to plan mentally, physically, and financially for your successful retirement. So all three factors are important. Now we have 3 phases of retirement that you know, you go through here. First section here, go-go years. We have this exciting couple here on a moped of some sorts, and they're the recent retirees. They just retired. They've been waiting all their life to retire. They have the freedom. They're ready to go. They're in great health. They're ready to travel and just see the world. So those are the go-go years. I'm finally retired and now I'm free. Like, do what I want to do. Now, then there's the settling in years, secondary here. And those are when, you know, you've passed the go-go year phase. You've gone through the, I've been everywhere. You've done all the things that you've been waiting all those years to do. You've done your travels. And then you settle in, things are a little bit harder now, you know, harder to do things. So you're settling in, you're enjoying your home. And then finally, there's the caregiving years. And those are the years where either yourself, you're going to need caregiving assistance from a loved one, or maybe you're providing caregiving assistance to someone you love. So those are, you know, caregiving years. So those are the 3 phases of retirement. Now, what's your retirement plan? So, you know, you want to retire to something instead of away from something. You want to have plans, goals, hobbies. I know I want to travel. I try to travel as much as I can. I mean, it's hard right now with the COVID-19, but, you know, I love traveling. I've been all over the world, Europe, Asia, cruises. So I try to travel as much as I can, but when I retire, you know, I'm going to want to travel some more. So I have those plans, goals, and hobbies, even though I'm 17 years away from retirement. But you know, other people, they are interested in volunteering. You know, maybe you have your city job now that pays the bills, but it's not your passion. But there's something out there that doesn't really pay any money, but that's your passion. You've always been interested in it, but you couldn't afford to live a lifestyle on that. So you volunteer in retirement. Mentor and teaching. I have an aunt that she loves to mentor and teach now that she's retired. So, you know, teach the new generation, teach your grandchildren or, you know, friends. So mentor, teach, and then stay fit. So we have our LACERS Well program that provides, you know, fitness options in retirement. We also have, you know, free fitness options such as silver sneakers, silver and fit for retirees, free gym membership. So, you want to try to, stay moving and stay healthy. And then you also want to plan for the changes of retirement too. There's going to be new routines and new responsibilities. I mean, right now, we have our routine. We work, our 9 to 5 every day, Monday through Friday, or 7 to 4, or whatnot. That alarm clock goes off in the morning. You got to be online by a certain time. So, but in retirement, you can make your schedule. That's up to you. You don't have a supervisor at work to tell you when you need to be at work. You are your own supervisor in retirement. So that brings new responsibilities. So lifestyle changes, what work provides, like I said, structures our time. It provides intellectual stimulation. For most of us, we have to think about what we're doing at work. You don't close your eyes and press a button, hopefully not. So intellectual stimulation, social contacts. I mean, it's a little hard right now. A lot of us are doing Zoom meetings only, but you know what, you're seeing people. You have to talk to your coworkers, whether it's on Zoom, email, phone, in person with masks. I mean, we have social contacts while working. In retirement, if you want to close your front door and, order Uber Eats and let them leave the food on the door and Amazon Prime all of your clothes and provisions and never see a single person, you could do that. But when you're working, you have to, talk to somebody. So it provides the social contacts at work. Builds your self-esteem. Hopefully your supervisor tells you when you do a great job, or you get a kudos at work, employee of the month, things like that. You get people telling you, thank you for helping me. So work provides that. Also gives you an identity. I mean, I'm a senior benefits analyst. That's how I identify at work. I have a job classification. I have structured things that I need to do. But in retirement, you're no longer, you're a retired employee. You no longer identify with that job classification. You have to find your new, retirement substitute. So you're going to need to plan how you'll spend your days, maybe join a club, LACERS well, like I said, free program through us. Set a goal, complete it, maintain and cultivate friendships. So just things to do. So a few more slides before we get to Steve. So retirement process. So let's talk about this. So right now, things are a little bit different for those of you who are here on the live page right now. Today is September 29th, I believe, 2020. So right now we have a couple of things going on with retirement that are specific to this time frame only. So if there's anyone viewing this later on as recorded, just know that this is for September 29th, 2020. There's a few things that are going on that affect retirement options and when you can pick your dates. Well, one of them would be the city incentive program. So that's taken place in the last few months. People have applied for it. No doubt some of you here and this seminar are CSIP. They call it CSIP applicants. So you don't have an option to pick your retirement date as a CSIP applicant. The CEO will pick that for you. So, going through this process here, you won't be able to pick a retirement date that will be chosen for you. So if you're CSIP participant, the process still is the same, but selecting the date is not. That will be provided to you later. And then additionally, for those of you that are not CSIP participants, but thinking of retiring, and later this year, early next year, there is an additional abeyance period that we are not accepting retirement applications for. And that's the abeyance period is from November 1st to end of January. So November 1st, 2020 to January 31st, 2021. We will not be working on any retirement applications that are outside of the CSIP applications. So very different time for us right now. So basically any application that for the next till end of January needs to get in before October 1st, or else you're gonna have to wait till February to apply. So there's just gonna be a period where where LACERS is working completely on the CSIP application process and trying to get everyone, trying to set up people to retire. So I'm going to go through this as if, you're able to select a retirement date, but, during this next few months, or CSIP participants, just know choosing your retirement date is not an option for this situation. So step one normally would be you pick your retirement date. Then you submit your application. Then gather your required documents, complete the forms that are mailed to you, make a list of questions, and you'll have an assigned counselor to assist you. So let's go over selecting a retirement date. So this is during normal time frames, so not between pretty much October through end of January. You would submit your application 30 to 60 days prior to your selected retirement date. So, and that's very important. You cannot, change. You cannot go outside of those days. You have to submit your application 30 to 60 days prior, and that's per the administrative code. So on a normal time, say you wanted to apply, retire 2 months from now, as long as it's less than 60 days, but more than 30, you can do so. Your last day on payroll will be the day before your retirement effective date. And if you want your last active check to be a full check, you want to retire at the end of a pay period, so AKA Saturday. Now, to shorten the time frame between your last active check and your first retirement check, you'll want to retire in the last pay period of the month. So that will just shorten the time, because remember, you're getting paid once a month in retirement. So if you retire, you retire during too early in 1 month, maybe the beginning of 1 month, you're not going to get paid your first retirement check until the end of likely the following month. So that's a month and a half, almost 2 months before you get paid again. So some things to think about. Now, required documents, you're going to need your marriage certificate or state registered domestic partnership certificate, birth certificate or passport, dissolution documents for any and all prior marriages or domestic partnerships. So if you've been married 4 times and divorced 3 times, you'll need 4 marriage certificates and 3 divorce documents, that type of thing. They need to see everything. They need to know if any exes are entitled to any part of retirement. So it's very important. If you don't know where they are, you'll likely have to contact the court in which you had your paperwork filed to get a new copy. So very important there. And Medicare card if applicable. So if you are on Medicare already because you're 65 or for whatever reason, submit a copy of the card. All of these are copies because we don't want originals. We want copies. And then state or federal issued photo identification, aka a driver's license, that type of thing. So those are documents you'll need. So get those ready if you're planning to retire soon or are a CSIP participant. You'll need all of these when it's time for you to fill out your paperwork. Now, if you or your spouse or domestic partner have birth dates or name discrepancies on your documents, you may be required to provide additional documentation. So if you already know you have those things, make sure you get those resolved so that you can, resolve those issues before we find them. If you have a divorce pending, but it's not finalized, you can still retire. You will retire and married unless the divorce is finalized prior to your retirement date. So that's something else to consider. And then documents in a foreign language must be translated or transcribed by a certified translator. So notarized copies are not acceptable. So just know that. And specialized counseling. So with that, I'm going to bring in Steve, who's going to talk about deferred comp. And then after he talks about deferred comp, we're going to take a 10-minute break. And then after that, Nathan will come in. So let's see if Steve is ready to join. Steve?
Again.
All right, perfect.
All righty, here we go. Okay, so I'm Steve Harmon. I'm one of the deferred comp reps. I always like to say I'm one of the long-time deferred comp reps. And we're going to talk about some stuff you need to think about as you approach retirement here. Let's see, now let me go on to the next page here. Okay, that's good. It doesn't want me to go on to, there it goes. So some basic features we're going to talk about in the plan here. It was mentioned before, Heather mentioned about contributions to deferred comp. Most of you are probably making pre-tax contributions to the plan because that's how the plan was developed many moons ago. That means money's coming off your gross pay, reducing your taxable income. Not a bad thing. It's always good to reduce your taxes. About almost 10 years ago now, they introduced the Roth part of the plan, the Roth 457. It's not a Roth IRA, as everyone calls us and says it is. It's Roth deferred comp, and all that means it's after-tax contributions that are labeled as Roth within the deferred comp plan framework. It's different from a Roth IRA because a Roth IRA is outside of the plan. Just to clarify that. So those monies come directly off your take-home pay when you make those contributions. So the advantage of the Roth contributions versus the pre-taxes, you're putting money that you've already paid the taxes on, depending on some other criteria that you see on the screen, such as having the account open for 5 years and being over 59.5, then the growth is also tax-free. Now, I want to reiterate something because it's a big rumor. I don't know who loves to perpetuate it, but please stop. There are no age 59.5 age restrictions on this plan. It's a 457B plan. You find the age restrictions on traditional IRAs and 401k plans, but this is a 457B plan, so that does not happen on this plan. In addition, your contribution could be both pre-tax and Roth. So we have a lot of people who do both pre-tax contributions as well as having some monies that are contributed on an after-tax basis. It's all up to you. It all depends on how you're going to the plan limits here. So for this year, if you're under age 50, the maximum contribution limit is $19,500, which comes out to around $780 a paycheck. If you are age 50 or older, the maximum limit this year is $26,000. And if you've been doing the contributions all year, that comes out to around $1,040 per paycheck. Now, this last revision is very important, especially if you're going to be retiring very soon, or perhaps you are thinking about going into catch-up because you're not retiring maybe this year, but maybe in 2 years or something like that. There's a provision in this plan which we call our special 3-year catch-up. That is the provision that allows you to contribute double the below age 50 limit. You can see that it comes out to $1,560 per paycheck. To be eligible for the special catch-up, though, you must meet both an age and years of service qualification, and the key word is and you have to be within the city's normal retirement age. So you have to be within 3 years of age 55 and 30 years of service, or within 3 years of age 60 and 10 years of service. So if you meet one of those two criteria, you pretty much could do catch-up. The exception to that is if you've been contributing the maximum contribution amount ever since you started with the city and been in deferred comp, then there's nothing to catch up on, because catch-up is making up the contributions you didn't make in your early careers with the city. So that's what catch-up is all about. I get phone calls, I laugh about them and said, why can't I do catch-up? I've maxed out my contribution every year. It just means you've been good with your contributions, and it's a good thing in the long run. So other things that you might want to think about, you mentioned, I know Heather mentioned about pension savings plan. You might want to consider rolling that pension savings plan money into your deferred compensation account. So if you were that famous student worker, or you worked in an election or something like that, you may have money in that pension savings plan that could be rolled into deferred comp, and that's money that could be used in the next bullet point, purchasing service credit. You could also roll in monies from other plans, such as other deferred comp plans, or if you have money in the private sector, the previously mentioned 401k plan, or even from traditional IRAs. You can use the pre-tax portion of your deferred compensation account to pay for buyback. So we do a lot of purchase of service credits that a lot of members of LACERS are doing. They've gone through the process, they've waited their time, they got their forms from LACERS and they saw the cost, and they put in the request to use their deferred comp money to pay for it. And that's a sweet deal because it's not a taxable transaction, because money is going from one retirement plan to another. So it's a nice way to pay for your purchase of service, use deferred comp money. Some other features in the plan. Some people want to convert their existing pre-tax dollars in the plan to the Roth parts of the plan. That can be done. You don't have to wait till retirement. So if you want to maybe pay the taxes now in your money and not wait till later on to pay taxes when you take out pre-tax money, you can do that. But I'm going to give you right now a buyer beware thing here. If you decide to convert existing pre-tax monies in this plan to Roth, It is a taxable event, but we do not take the tax out up front in that transaction. What will happen is we will send you a 1099 form the following January for your tax reporting. So when you file your taxes, that is where you're going to pay taxes if you decide to convert existing pre-tax monies to Roth. And I say be careful because you got to have the money to pay the taxes, plain and simple. If you do a large amount of money, hopefully you have a large amount of money to pay the IRS and or the state of California. So please be careful on that. We make you sign a disclosure now on our forms that you understand that, and if you have buyer's remorse, it's too late. So you make sure you know what you're doing. Talk to your tax person before you do that transaction if you decide to do it. Some things that you might want to think about that we offer to kind of understanding your account a little bit. We have a great retirement calculator that is available on our website. You do have to program it with your LACERS information, but once that is done, it's factoring in what you might get over a certain amount of time between your pension with LACERS and your deferred compensation account. It uses a standard actuarial formula, because it was mentioned, I saw in the LACERS presentation, you could spend anywhere from 25 to 30 years in retirement. So I believe the default is you're going to spend 25 years in retirement. You could program other assets you may have, and it's going to tell you if you're going to have enough money for retirement or maybe not. There's always the dread that you got to put more money into deferred comp. Not necessarily a bad thing, because I always tell everybody, put more money into deferred comp to, oh no, I got to work 5 more years. You don't want to do that. Other things too, if you're going to get any Social Security, you can put that in there. Other monies, put that in there, and it'll give you an idea what you're looking at if you are meeting your retirement goals or not. I will say though, this is not the end all though of calculators. It's just a guide though. It's not the actual thing. A true financial plan will tell you if you're on track with your retirement goals or not. But again, this is just something to give you quick and dirty idea how things are going with your retirement planning here. Other things too, you could also program your account to automatically increase its contributions. Again, I always tell people increase those contributions, but you know, life happens and it's very easy to forget, oh, I meant to put another $50 a paycheck or another $100 a paycheck. Well, with the contribution rate escalator, you can program your account to automatically increase by a certain dollar amount or by a certain percentage, maybe every year or twice a year, or maybe every 3 months. Neat way to make sure your contribution is increasing, and you control how much it could increase. And there's a ceiling to the automatic increase. So if you want to stop after a certain period of time, that can be done. Other basic features of the plan, some of you may already probably have done this over your time with the plan. You could move monies from one fund to another, change the way how your contribution monies are coming in, things like that. All sorts of little nuances you may do to your account along the way. We also talk about your banking information, and that's something since Voya's taken over the plan, you may want to think about putting in your banking information in our system. The reason for that is going to make it easier in the long run to withdraw money. Once we have your banking information in our system, you put in a request to withdraw money when you retire. It'll be direct deposited to your designated checking or savings account. That also applies to loans too. If we have your banking information on file and you wish to do a loan, then instead of mailing you a check, we can now direct deposit those funds. So good reason to put in your banking information. I will say, if you do change your bank information, please update it with us because we do not receive it from any other source. A lot of people, just like beneficiaries, which I'll talk about later, believe we get it from the city's retirement system, LACERS. We do not. The only thing we might get is your retirement date, and that's it. But we don't get any information such as your banking information or change of addresses. That's on you to let us know that, so keep that in mind. All right, I talked about the famous loans. So with deferred comp, you can borrow up to 50% of your account balance or $50,000, whichever is less. And for most loans, you could have up to 5 years to pay back those funds. If you're using it to buy what I use the term principal residence, then you could have up to 15 years to pay back those funds. When you do a loan up front, there's a $50 loan application fee, and then there's maintenance on the loan, which is about $25 a year. Taking out a rate, I believe it's about $6.25 a quarter. You could always pay back the loan in full at any time. Other thing, if you want to make extra payments, you can submit a form and submit extra payments if you want. When you go into retirement, though, you will have to make a decision with what you're going to do with your loan. And that is, you can either pay it off, you can convert it to what we call a retiree loan. So, excuse me. So instead of having those monies coming out of your biweekly paycheck, which you won't be getting anymore as a retiree, they'll then come out of your designated checking or savings account, which you'll provide to us. We're not allowed to take it from your pension check. And there is another option, believe it or not, when you retire with your loan, and that is you don't have to pay back the loan. Not a bad deal, but unless you owe about $50,000 on your loan, that's another story. Because if you decide not to pay back your loan upon retirement, then whatever is the outstanding balance then would become taxable income, and we would send you a 1099 form. If it's a small balance, I'm not your tax advisor, but think about that. Maybe less headache in the long run, but we could always talk about different scenarios if you want to talk about your loan outside of this deal here. Fees. Everyone always loves to know, what fees do I pay in this deferred compensation plan? It's pretty darn cheap because we're dealing with a lot of people who work for the city, both sworn and civilian, along with even those folks from DWP. They help because we're dealing with all these people here. That's what keeps the administrative fee low. And now it's down to 0.09% of your total account balance, not to exceed $115 annually. So if you've got $500,000 in your account, and we see that regularly on a daily basis, you're only paying out as an admin fee $115 a year. Keep in mind, if you have loans in your account, you may be paying for the extra fee for having loans. If you have the self-directed brokerage account through Charles Schwab, you might be also paying for that as well. The only other fees that are in the plan are built into the fund returns, and those are the investment management fees, and that depends on investments. Now, the city's deferred comp board, not VOIA, but the city's deferred comp board chooses the funds that are in the plan. And traditionally, over the last couple of years, they've been choosing a lot of index funds, which traditionally don't have fund managers doing active buying and selling. They've added on within the fund categories some actively matched fund, but keep in mind it's blended with index funds, which don't have fund managers. So in an overall basis, they're still pretty darn low in terms of investment management fees for the funds. That information for each fund, by the way, is on the website. So let's talk about account access, another popular question. So if I get questions every day along with my colleagues about how do I access my account online? You can see the website on the screen there, la457.com. You need to have a PIN number. So when VOIA took over the plan almost 3 years ago now, you were mailed out a PIN number, and with that PIN number, it let you establish the username and a password, and that's how you gain access to your account. If you don't have that PIN number anymore, or you've lost it, or dog ate it, whatever the case may be, you can call the toll-free line there, 844-523-2457. Upon verification of name, address, birth date, rank, file, serial number, all that good stuff, they can mail out a PIN to you, and you could create your username and password. If you did create your username and password since VOIA took over and you forgot it, not an issue. Go to the website and just, as I tell everyone, click on forgot username, and then once you got your username, click on forgot password. You'll get right in there. Alrighty, a lot of you do a lot of things on your smartphone. I do things on my smartphone too. I live on it. If I don't have it, I'm in trouble. We have an app that works on both iPhones, Apple phones, whatever you want to call it, your iPhone, iPad, your Android. I'm an Android person. VOIAretired.com. You can do your basic transactions on there. Use the same username and password on the regular website. Quick way to do your transactions. I like it. Now the fun part. Distribution options, of course, when you can take out the money and how you can take out the money. So when can you take out your deferred compensation monies? Someone had asked that question during the presentation. I kind of answered that to that specific person earlier, but for everybody here, once we have your retirement date, so about a month after you retire, VOIA is fed your retirement date from the city, and once we have that date, you can take out money in any way you want, and we'll go through this methods in just a few slides here. If you're not going to retire and after this presentation you decide to leave city service, that's the generic term we use, which is severance of employment. So once you no longer work for the city, you have access to your money, again, a month after you break employment. Now, there's an age in this plan where you have to start taking out money if you are no longer working for the city, and we call that factor required minimum distribution. Again, I'm going to talk a little bit more about that in a few slides. It used to be age 70 and a half, but they raised the age this year to age 72. However, minimum distribution for this calendar year have been suspended due to the coronavirus. So if you are going to be turning 72 next year, or will be turning 72 and you retire this year, you don't have to worry about your minimum distribution this year. Next year, probably, unless there's some declarations proclaimed or anything like that. But at age 72 is now the new age where you have to start withdrawing money from the plan if you are already retired and you haven't done so previously. So how can we talk about when? Now the how part. You can always take out the whole thing, but remember, for those of you, most of you have pre-tax monies. So whenever you take out money, it's going to be considered taxable income in the year that you take out the money. So if you've got a lot of money in your account, $500,000, not a tax person, but I would say that lump sum distribution may not be the best thing to do. But again, it depends on what your individual situation may be. Maybe you just need some money here and there, and we call that a partial distribution or partial lump sum. Maybe you want to fix the roof on your house from the rains that happened many years ago. You want to treat yourself to a cruise, really nice cruise, buy a motorhome, down payment on a motorhome, buy a Harley Davidson, whatever the case may be. Partial lump sum. One of the more frequently chosen options that I tend to see is people choosing what we refer to as installment payments, which is like you're telling us a certain amount you're going to get each month. So that you take that money in conjunction with your retirement check from LACERS, it could be the feeling of you're still getting a biweekly paycheck, so to speak. So if you decide to take out an installment payment, you choose the dollar amount or the period of time that you want to use the money, and you have 2 days of the month where you could choose that we process those distributions, either the 1st of the month or the 15th of the month. And by the way, you could do that also online as well, or on paper form. The other part, got to mention the T word, taxes, and I'm just the messenger here, so maybe this is good. We're working from home here, so I can't be completely attacked on the taxes here, but you're always going to pay federal tax. Now, for most distributions, and listen to what I'm saying here, read between the lines. For most distributions, we are going to withhold 20% for federal tax. And if you are here in California, we're going to withhold 2%. If you move to another state that doesn't have state tax, then that state's individual taxing situation will apply, whether it's no taxes such as Nevada, or I'm just going to throw out a state at random, nothing negative or positive about Tennessee, Nebraska, whatever the case may be. That's how it works there. So whatever state you live in will determine what state tax will apply, but you'll always pay federal tax. Again, there's no 10% penalties for withdrawing deferred comp monies prior to the age of 59 and a half. With the Roth part of the plan, 59 and a half is an age in the plan, but there's no early withdrawal penalties. That age, along with, again, how long you've had the Roth established, is only going to help figure out if you have to pay any taxes on any growth of Roth contributions or not, but there's no early withdrawal penalties on this plan. Again, I talked about required minimum distribution. So normally, if you retired this year and you were age 72, the IRS says you have to take that first distribution by April 1st of that year, and then withdrawals must be taken annually thereafter by December 31st. And we always have to say, if you don't take out your required minimum distribution, there is a potential 50% penalty if you don't meet that requirement. That won't happen while Voya is the record keeper. What Voya does, though, we will send you the letter saying, hey, you're 72 years old, you've got to start taking out some money to meet RMD. If you ignore us, which a lot of people do, I don't know why, we're nice people, but if you ignore us, what will happen is Voya will then execute that minimum distribution so that you don't get in trouble with the IRS. And they'll do it at pretty close to the latest possible time frame so that you don't get in trouble with the IRS. So pretty much it's an automatic deal. If you need that first minimum distribution by April 1st, they'll usually take about 10 days before that April 1st deadline to meet that deadline, or if it's by the end of the year, they'll take it out usually around the 15th to the 20th of December to make sure, again, you meet your minimum distribution requirements. In addition, let's say you set a dollar amount out. Let's say you decide to take $1,000 a month. And if by the end of the year, if you're age 72 or over, and we see that you're not going to meet your minimum distribution requirement, no problem. That December distribution, they'll do a supplemental distribution to bring you up to standard so that you'll never get in trouble with the IRS. That's a nice feature right there. With direct deposit, I talked about that earlier. That means you get your money a little bit sooner, 2 to 3 business days after we process your distribution. Now, here's the kicker here. It must be online at least 7 days prior to your putting in a request to withdraw money. If you're putting in a distribution request and trying to set up your direct deposit at the same time, it may not happen direct deposit because that information has to be on file at least 7 days prior to your request to withdraw money. Otherwise, we're going to mail a check out to you 2 business days later. It comes from the East Coast. If I knew there was a checking machine closer, I would be in line for it. It takes about a week to week and a half to come from the East Coast to out here in Southern California. But if you do need it sooner, you can always pay express mail delivery $25, and hopefully somebody nice from UPS will be knocking on your door with that check. Beneficiaries. Oh, please keep your beneficiaries current. Oh my goodness. Now, who you name as a beneficiary as LACERS is completely independent of deferred comp. So do not confuse beneficiaries with LACERS nor with deferred comp. They're independent. So make sure on your deferred comp account you have your beneficiary the way you want it. When you get your quarterly statement, we show you who your beneficiary is. If my name is on there, please don't take it off. I doubt you'll see it there, but you know, got to try there. If you have a spousal beneficiaries, they're going to have the same options as you pretty much in terms of taking out the money. They recently changed the rules for non-spousal beneficiaries, where it used to be a little bit more restrictive. In the past, they used to have to take the money out within like a 5-year period. Now it's 10 years, so it's gotten a lot better for non-spousal beneficiaries. Once the beneficiary gains control of the account, they're going to control the investment strategy. So let's say you had everything in the large cap fund, your beneficiaries may want everything in the stable value fund, or maybe you had it in the stable value fund, they may want it in the large cap stock fund, just as an example there. And then the beneficiary is going to name his or her own beneficiaries. So there's always a legacy for the money to go to somebody, because we don't want it to go into your estate and then it gets drawn out and whatever happens there is not good. Name a beneficiary, keep them current. If life events happen, change the beneficiaries, whether you're adding on somebody or if you have to delete someone. But please keep your beneficiary current. This is another good part. This is, I'm going to say, the pay attention part here slide. So when you retire, one of our many used features is that you could put in your unused sick and vacation time and any overtime that exists into your deferred compensation account. It counts towards the maximum contribution of the limit in the year where that deposit is made. So it could take all of your vacation hours, half of your 100% sick time, and any overtime that exists. We do not look at the 75% sick time. We do not look at the 50% sick time. You might get paid some small portion of that 50% sick time, but that portion is not eligible to go to deferred comp. It's a whole weird story. We're not even going to go to it in here. Bottom line answer, and you're going to have to accept my answer. The 50% sick time cannot go to deferred comp, period. So it's only the 100% vacation and half of the 100% sick time. There could be some planning involved with putting in that money depending on how much you're currently putting in the year. If you're getting ready to retire, like say in November, and you've been doing the maximum contribution limit, there might not be much we could put in there. But if you're going maybe next year, early in the year, then we can probably capture a good year's portion of contribution, depending if you're going to get a large payout. To do this, there is a form that we need you to complete. You will need to contact us in the local office. Although we're not there, we'll get your message and one of us will contact you. And we will send you the form, at least the accrued leave form, maybe the catch-up form, because maybe we need to put you into catch-up so we can capture more of that payout money. And some of us, like myself, I include an instruction sheet, so it's almost hopefully foolproof in terms of completing the form. Follow the simple directions, you'll do it perfectly there. If you need to reach us, the fun part now. Obviously, in a normally working world, we'd be at different locations. Like I'd go to the Valley a lot in the Port of LA. Latanya Harris, my other colleague, goes to the airport, but that's not happening right now. We're all working from home. So if you need to reach us, a couple of ways you could do that. You can call the City Hall number to 213-978-1601. leave a message. We will get you. There's 5 of us who work on this plan, and we take turns throughout the day retrieving messages and making phone calls. My list of people here, I show you my list. Do this a lot of the day. You could also email the city's general email account, which is perdcp@lacity.org. Now, I'm going to go out on a limb here. If you want to reach me specifically, I've been around here a while, see the gray hair. My email address is Steven, S-T-E-V-E-N, then a period, and then my last name, Harman, H-A-R-M-A-N, @voya.com. That's another way you can reach me by email. Otherwise, you can just send it along to the PFR. You could ask for me. If you don't like me, I won't cry too much, but any of us will help you if you decide to send a message through the PFR address. Questions, the fun part now. Now I get to back out of the slide and hit that little question button there. So let's take a look here. Only one little measly question. Let's see. Is there early withdrawal penalties? Again, so there are no early withdrawal penalties for deferred comp withdrawals. You just have to no longer be working for the city to withdraw those funds. That was the question asked by Yosu. All righty. Any more questions? Are you all awake? Because you got to be awake for Nathan. If you're not awake for Nathan, I did bad.
Well, you know what, Steve? Sometimes different individuals are more well-versed in deferred comp than other times. So that could be an explanation for it. So, well, let's see. Maybe you got a couple more. Let's see what we got now.
I see. Possible. Can we withdraw before age 72? Good question. If you're not, once you no longer work for the city, the answer is yes. Again, age is not really an issue with this plan. It's you're working for the city. So once you no longer work for the city, you have full access to your deferred compensation account in any way you choose to withdraw that money. 72 is just the age where you have to start taking out at least a certain portion of your account every year to keep the IRS happy. That's all 72 and later on is. Let's see. I think that answered that question. Oh, another one popped in. Can you take out a loan after retirement? Oh, that's another good one. The answer is yes. You can still do a loan even in retirement. It's the same rules that apply. 50% of your account balance or $50,000, whichever is less. The only difference is the payment mechanism. Since you'll be retired, how are you going to pay back the loan? Well, you're going to supply us your banking information. So on a monthly basis, about near the end of the month, 7 days prior to month end, we'll begin the process of getting that money out of your designated checking or savings account. And so it'll be a monthly payment that you'll provide to us. So you're still paying yourself back both the principal and the interest, just like being an active employee, except it's a monthly payment instead of a biweekly payment. Now the questions are coming in here. Let's see. I used the catch-up this is from Adele. I used the catch-up 3 years ago, but did not contribute the max. Can I contribute the difference now? If you did the special 3-year catch-up already, it's a done deal because that's a one-time deal if you've done the 3-year catch-up. So if you didn't do the max and you were in the catch-up for 3 years, unfortunately, you're done with that catch-up. If you're still in it, you still got the end of the year depending on when you did, but if you've already utilized 3 years, it's a done deal. Again, Pauline, this plan does not have 59.5 penalties for withdrawing the money, period. Let's see, Harry has a question. Can you transfer to a self-managed IRA? Like if you want to roll over the money to a traditional IRA when you retire? The answer is yes. You could always, that's an option if you don't want to keep the money in deferred comp. You could always roll it to an IRA. Just make sure you know what fees you're paying, or if you're going from an advisor, you're going to be paying any extra with an advisor. A lot of people are not aware of the extra fees you could be paying, but the answer is yes, you can do that. Let's see, Victoria. We can catch up 39,000 for the last 3 years. That means we can catch up 3 years of 39,000. That means we can catch up 39,000 times 3 years in 2020. Okay, let me try to answer that one. A lot of moving parts to that question there. So 39,000 is per year to contribute and catch up. If you enrolled in catch-up this year, that means this year, calendar year 2021 and 2022, you'd be able to contribute those 3 years at $39,000, provided that you have unused money that you didn't contribute that allows you to do the $39,000. So it's up to a 3-year situation. After those 3 years, if you're still working for the city, then you revert back to the age 50 limit, which is currently $26,000. And following up on Victoria's question, James asks, can you still contribute after retirement? Oh my goodness. That's a very popular question, but you're not going to like my answer. Unfortunately, no. Monies to deferred comp can only come out of a regular active paycheck. Can't come out of your pension check. So once you retire, those contributions stop completely. Let's see, Rick. Is Roth IRA contribution handled by Schwab? So, okay, again, the Roth in our plan is not a Roth IRA. I have to specify that because it is a big difference. However, if you are looking to have the self-directed brokerage account in the Schwab, or let's say you already have one with your pre-tax monies, you would have to open up another one with Schwab to handle the Roth monies. They don't combine in the Schwab account the pre-tax and the Roth monies. So if you're in deferred comp and you got the self-directed account with pre-tax and you have Roth monies and you want to put that in self-directed, you will have to open up a self-directed part of Schwab for the Roth monies. That's how that works. All righty. I don't think there's any more questions for one snuck in. Ooh, look at all that, 2 questions snuck in here. Is the accrued leave form available online? I believe it is, but before you do that, send us a message, because if you talk to myself or one of my colleagues, not only will we send you the form, we'll possibly send you an instruction sheet so you fill it out correctly. So that way, if you send it in and it's filled out wrong, we don't have to contact you and try to get it all squared away there. So before you do that, talk to us first so we can make it easier for you in the long run. Let's see, another question. Voice shows max 980 per pay period. You showed 1,000. So again, if you're under age 50, the maximum contribution limit this year is $19,500. That comes out to $780 a paycheck. If you're age 50 or older, that limit is now $26,000, and I use it over 25 paychecks because the math is smoother. It comes out to $1,040 per paycheck. And again, catch up, if you're in the 3-year catch up, that comes out to $1,560 per paycheck. All righty.
All right, Steve, I want to say thank you so much for your time. If anyone has any further questions for deferred comp, please contact deferred comp directly.
Excellent. Thank you. You guys have a good one.
Thanks, Steve. Yeah, you too. So with that, everyone, why don't we take a break and let's come back at 3:25, and then I will get started on those medical benefits, survivor benefits, and those topics. So we'll see you soon at 3:25. Thank you. All right, everybody, welcome back. I've got 3:25. I'm Nathan with LACERS, and we're gonna go ahead and get started. First, want to thank Heather and Steve for all the great information in the first half of today's webinar. Still got good information here, so let's get this PowerPoint up. All right. So first, let me begin with leaving city service prior to retirement eligibility. Many of us are gonna, go right through until retirement with the city, but some of us may take advantage of other opportunities, okay? One of those that's pretty common is actually transferring or promoting to DWP. So the one thing that we like to share with you at LACERS is that DWP is a completely separate retirement system, okay? So, a lot of times DWP pays more. I look at my job class and I can make more money with DWP. It's something I've thought about when things become available. But if I'm gonna make that choice, or if you're gonna make that choice, just be sure to understand how it might affect your benefits, okay? Because for example, you may be a tier 1 employee with the city of LA. What tier will you be at the DWP, and how will that affect your retirement benefits? Things that are important to you, like how your calculation is made, what your health benefits look like, and things like that. So if you're looking to go to DWP, more power to you, but just give them a phone call, send them an email, and just really learn about what you're getting into by transferring, because again, DWP is a separate entity for retirement entirely, okay? So not everyone's going to leave the city because they're going to DWP. You may just have a better option out there for you. Maybe it's in the private sector, for example. When we did the poll at the beginning of today, we didn't really see any of you had less than 5 years of continuous service. But in case there's one of you out there, you know, if you haven't been with the city for 5 years, you can, and you're going to leave the city, you can either leave your contributions on deposit and withdraw them later. Or you can take an entire refund of those contributions, for example, to roll those funds over into a qualified retirement plan. So that's a lot like if you've ever worked in the private sector and you left, you know, you're taking your money and going to roll it to where you end up at next. Now, again, I think probably most everyone on this call, and definitely everyone that submitted the poll, was 5 or more years of continuous service. And the main difference there is that you've worked enough to be eligible for a deferred service retirement. Okay, so that works differently. All right. As far as a refund of contributions, so we do have members that say, you know what, I just want to take my money out. You know, I'm leaving the city. I don't want to retire. I just want my money. You can do that if you're leaving the city because your contributions are technically the contributions that you made. But, you know, you're giving up retirement benefits, for example, okay? And also, you know, because you're taking out this money that you had never been taxed on, you're going to pay a fair amount of taxes to do that, you know, to take that contribution. I have seen this where individuals are really behind, for example, with debts, or they've got a note coming up on their mortgage and they think that this is the best way to go. And it is a personal decision. So I'm not telling you how to operate your life, but just understand that as you can see on the slide here, okay, you're not going to get that whole amount of money by any means, right? So it may be in your best interest to look at what options are available to you. Can you get a personal loan? You know, what can you do versus just, hey, saying, you know what, give me my contributions back. I'm leaving the city. I don't want any retirement benefits, because that may change later. You know, at 57, you may not be too worried about it. And you just want that, you know, $78,000 after taxes. But when you're 63 and you desperately need really good medical care and you can't get it from the city anymore, you may think back and go, I wish I would have done something differently back then. So just something to keep in mind, that you can, you know, forego a retirement altogether, but just understand it definitely has some drawbacks. So touching upon the deferred retirement a little bit more, as we showed you a few slides ago, you know, I think Heather talked about it in the first half. I started with the city at 18. I'm 48, 49 years old. I put in 30 years, and you know what? I'm ready for something a little bit different. But I know that I want to get a full retirement allowance. So what some individuals do is that they leave and then they come back and retire, you know, effective on their 55th birthday, so they can get a full allowance and then start collecting their pension from the city. So, you know, again, 55 years or older with 30 years of service, or age 60 or older with 10 years of service, or age 70 or older with at least 5 years or more of continuous service. So these are ways you can get a full allowance, even if you're doing a deferred retirement, okay? You know, a lot of people that do this type of stuff that I've seen, they tend to have a really good job opportunity elsewhere that pays more, or else why would they leave the city, right? I mean, the city pays pretty fairly, but some individuals will find out that, oh, the state pays more for my job and they have an opening, or the county pays more for what I do, things like that. So it does happen. Again, it's not all that common, but it's something that you can do. So maybe you don't have to bypass a really good opportunity financially just because you're not 55 yet, you know. You can also do a deferred early retirement. You know, there may be some individuals based on their personal situation that they don't care if they reduce their allowance. So if they're age 55 or older, as a tier 1, they have at least 10 years prior to the effective retirement date and 5 years of continuous, then they can also do it. And again, that's always a personal decision. For some individuals, you know, that they may say something like, you know what, I might be getting a reduced allowance, but I'm going to collect the money a lot longer, so I'm okay with it, you know, or I'm just ready to retire, you know, and I'll take a little reduction because I'm really, really done. Okay, that can happen too. So survivor benefits, you know, the end of our our life on earth here is passing away regardless of your beliefs, your personal beliefs. So, one thing that I like looking at here are survivor benefits with the city, because it just gives me a little bit better feeling about this, that, even upon my death, my designated beneficiary has some entitlements coming because of my choice of career, my career path with the city of LA. A continuance benefit, health benefits is huge. If I pass away before my wife, I feel very comforted knowing that she can still enjoy some really good health benefits at no cost or at low cost, okay? And of course, any unused contributions, if there's any of that, and a one-time burial allowance, and even my retirement allowance in the month in which I pass away, because we are paid for every day we're living, okay? So again, regardless of how you're feeling about death and something you probably maybe don't even want to talk about today, it's good to know there are some benefits to those you leave behind. And I hope that helps make it better. All right. So let's talk about first, if you pass away while still being, still working, right? So this is not ideal for most of us. None of us want to die while still working for the city. But again, there may be some benefit options available to our survivors. And of course, that's going to depend on our service credit, how long we worked with the city, our age, were we eligible to retire, we just hadn't retired yet, things like that. Survivor's relationship to us, is this my spouse or domestic partner, for example? And then how beneficiaries are designated. So, do you have your spouse listed as your sole primary beneficiary, things like that. So when it comes to survivor options, and this slide's the next couple slides are a little bit busy, so I'm just going to try to kind of cut through all that and just try to make it a little straightforward. The longer you work with the city, and many of you appear to have worked for the city for some time, the survivor options get better, okay? So, the bare minimum, I was barely started working for the city and passed away. At least they can get my contributions, because again, those were contributions I made to the plan. If I work a little bit longer, could be some limited pension opportunities for that survivor I leave behind. And, if I've worked enough, then a survivorship becomes an option, okay? And that could be a lifetime monthly allowance, which would be great for them, okay? So there's different types of survivorships, and I don't want to overwhelm you. You've got a service retirement survivorship, which is basically, I was eligible to retire, I just hadn't retired yet, okay? And I passed away. So in that case, my survivor can immediately collect benefits based on the fact that I was eligible to retire. Deferred service retirement is, I passed away, I'm not yet eligible to retire, but if I would have lived, if I become eligible to retire, then they can start collecting the benefits. And then finally, sometimes a disability survivorship becomes the option based on, for example, the member becoming disabled prior to their passing. If you're ever looking at a disability retirement for whatever reason, please do contact LACERS and speak with one of our disability retirement counselors. Again, all these decisions are personal decisions. So LACERS is never going to tell you one way or the other, but we want to arm you with good information so you can make an informed decision. And that's why it's great that you're here today, because you're learning more than individuals that don't attend these seminars. So good for you. And again, as I mentioned before, a lot of information when it comes to survivor options. But again, as you work more, so for example, let's just jump to the bottom of this slide. If you've put in 5 or more years of continuous service, then you have the best possible survivorship options for that survivor that you leave behind. So, this time with the city has been well spent in more ways than one. Also, it's not just for, husband and wife. It could be for a domestic partner. So your domestic partner can also be eligible for survivor benefits. You just want to make sure that LACERS is aware of this domestic partnership, either by submitting a form that we have on our website that's LACERS specific, or if you've already registered with the state of California, you can also provide us a copy of that, okay? And while we're on that note, any documents you need to provide LACERS, photocopies or scanned copies tend to be acceptable, okay? So you don't have to give us originals, because that's kind of risky if it gets lost. I know Steve talked about beneficiaries for deferred comp. It was good of him to mention that, beneficiary assignments are different between all these different systems. I wish it wasn't that way, but yes, your deferred comp beneficiaries are different than LACERS, which is different from personnel. What I can tell you is the best thing to do is to always keep your beneficiaries up to date. Have I seen situations where someone's estranged boyfriend or ex-boyfriend or ex-girlfriend gets their money? Yes. Okay. So don't let that happen to you. Keep your beneficiaries up to date. You know, you want to make sure that you're leaving your benefits to the right people. Nothing would make you feel worse than knowing that, you know, someone's going to go spend all that hard-earned contributions you made to your benefits on a new car instead of your children getting it because you didn't update your beneficiaries. Okay. What if you don't choose a beneficiary? Then at the bottom of the slide, you can see how it's paid out, and that's based on California state order of succession. Again, my advice, always keep your beneficiaries up to date. If you're wondering how to do that with LACERS, you can go to our website, download the form, complete it, and then send it in to us. Family Death Benefit Program. This is a voluntary program. So if you've got some time until retirement and you have you have a young family or dependent parents, this is something definitely worth your consideration. Okay. I'm personally a participant in the Family Death Benefit Plan. You know, I'm married. I have 3 children, okay, ages 7, 4, and 4 months. So I definitely have a young family. Okay. And my parents, I'm still blessed to have them in my life, and they're getting older every day. So knowing that if I were to pass away unexpectedly and I'm still many moons away from retirement, it's good to know that there's some financial benefits payable to those I leave behind through this program, which is separate completely from your LACERS retirement benefits. What I like the most about it is that it's only $2.40 a month for the plan. If you want to learn more, visit our website. You can learn about what the payouts would be and things like that. I think everyone on this call has been with the city at least 18 months, so you can enroll without delay, okay? Now, if you are eligible for retirement, then typically this is not something you'll consider because those retirement benefits would be paid out to your survivors, okay? And that's listed here at the bottom of the slide. But I'm many, many years away from retirement if I'll ever retire at this point, because that third baby was a surprise, let me tell you. Okay, so and then here's the website. Just a little snapshot of our website where you can learn more about the Family Death Benefit Plan. All right, so let's talk about medical and dental benefits. I think you're all going to have a pat yourself on the back moment here. Simply put, you know, for a lot of your friends in the private sector, your neighbors and such, they'll probably come to you and complain about how they had to go find their medical and dental plans. They had to become a dental medical plan expert. The plans are expensive. I didn't save enough money for this for my retirement. I can't go on these trips and such. And then you're going to look at them and try to have empathy for them, but you're going to know in the back of your mind that your plans are a lot better priced. You got a subsidy to help pay for part of the plan or all of the plan. And every year, LACERS goes and does the work and makes sure that the plans that you have to select from are great plans. So once you are in the act of retiring, okay, your medical, dental benefits and such will no longer be handled through the personnel department, right? They're going to be handled through LACERS. So we become your benefits administrator. So we need to educate you on the options that you have. So each year we do create a health benefits guide for you with the most up-to-date information. So you can read through that at your leisure, and it'll help you make decisions during open enrollment time. Admittedly, a lot of retirees are happy with the plan they choose and they rarely change it. But you know what? You can change it during open enrollment if you wish to. And the health benefits guide really is your user's manual to give you the information you need to make the best decision. If you ever lose it, don't worry about it. There's always a soft copy available on our website. So who's eligible for these health and dental plans? First and foremost, you as the retired LACERS member. I know you don't hear it enough, but thank you for all you do and have done for the city. We're all a team, we're all a family, and we do what we can to make this city great. So we definitely deserve some options here in retirement. Also, your eligible dependents, which I'll outline on the next slide. And again, an eligible survivor receiving a continuance or survivorship. So again, you know, I pass away before my wife, and you know, she can still enroll in a nice medical and dental plan even though I'm gone. Okay, and that just feels right and good. So eligible dependents, of course, you know, legal spouse, domestic partner, obviously. Dependent children under age 26, notice that there is no college requirement there, but if they can get medical coverage through their employer, then they cannot be on your plan, and that's probably better, because as you add more dependents, your plan cost goes up, okay? You can also add a disabled child. You can see the details there. And also in some cases, you can cover a grandchild, all right? Now, admittedly, the least expensive plan is always gonna be individual coverage on an HMO, and then the plans rise from there up to, a family on PPO, okay? So just understand that if you add additional dependents, that raises the cost of the plan, okay? Just something to know. Health plan subsidies. So this is something that your neighbor who worked at Hewlett-Packard their whole life is probably not gonna enjoy, but you will, okay? A subsidy is a monthly dollar credit applied to help lower the cost of your medical or dental plan. Now, what if you don't need LACERS at all for your medical or dental? There is no cash in lieu, okay? So if you don't use the plan, you don't use the plan, but there's no nominal amount of money that you'll receive because you have coverage, for example, through a spouse or through something else you did in your life, okay? Now, eligibility for the subsidy, okay, starts at age 55. So if you retire before 55, you can still enroll in a LACERS plan, but you'll pay full cost for it because you're not yet eligible for a subsidy. So you got to be 55, retired from the city, have at least 10 years of service, and be in one of our plans. Or if you're an out-of-state individual, then you can look at our NPRP program, which I will discuss as well. So here's a nice look at the current medical subsidies for the 2020 plan year, okay? So you'll notice that starting at 10 years of service credit, the subsidy amount is $716.32. So that's the amount of money on a monthly basis that the city pays towards your medical plan premium. So you pick a plan that costs under that amount, then you don't have a deduction from your retirement allowance. But you pick a plan that costs this much and your subsidy is this much, then that difference comes out of your retirement, okay? For each additional whole year of service credit, you see the subsidy amount rises. So if you're going to retire and you have 17.89 years of service, it might be in your best interest to work a few more pay periods, get that 18. We know that medical plan costs tend to rise over the long term. Not every year. For example, from last year to this year, it was pretty flat, but the trend is upward, right? So it's always good to have more of a subsidy. And with 25 years of service credit, you max out and you have 100% of the maximum medical subsidy. Some people look at that and say, well, then why am I still working? I've been with the city 27 years. Well, just remember that you're still increasing your monthly retirement allowance, right? So it's always worthwhile if you want to continue working to continue doing so, okay? The dental subsidy works a lot the same way in the sense that you got to be 55 and you have to have the 10 years of service, and you want to get more service credit to get a higher subsidy amount. But there is a difference, okay? And that's noted on the slide. LACERS does not provide dental subsidies to your dependents or survivors. So back up a minute. On the medical side, let's say you max out 25 years, you have the 1790. That amount can help pay for yourself and your wife's monthly medical plan premium, okay? The difference is on dental, the city, what they're saying in this note is we're only gonna help cover your monthly dental plan premium. Is that a huge deal for most people? No, okay? The plan cost for dental is very reasonable. So this isn't life-shattering, earth-shattering stuff, but just understand if I'm gonna cover my wife, for example, I'm going to have some type of deduction, okay, from my monthly retirement allowance because the city is not, the subsidy won't cover her at all. That's really what we're saying there. So understanding your deductions, and at the end of today, I'm going to go through a couple of our most popular plan choices upon retirement so you can get a feeling for what this looks like, but just understand that holistically at the 50,000 foot view, okay, your LACERS health plan deductions, meaning what comes out of my retirement allowance, is going to depend on the premium of the plan I choose, okay? The number of dependents I have on my plan, my Medicare status, and all that balanced against my subsidy. So again, I'm going to cover myself on an HMO plan. Okay, that's going to have a lower cost. Then I'm going to cover myself, my spouse, my son, my grandson, okay, on a PPO plan. I'm gonna pay for that because that's an expensive plan with a lot of bells and whistles, okay? So just understand that at a high level, you know, this is how it works for you in understanding your deductions, okay? Medical plan options, I really like this slide because I see familiar providers, okay? So I see Kaiser, I see Anthem, okay? I'm a huge Anthem fan. My wife's Anthem doctor saved her life at one point, okay? So I'm very thankful to Anthem, and that's just my personal experience. Some people are big Kaiser fans and such, but what I like seeing here is that even in my retirement years, as it stands today, I could still work with Anthem, okay? Or you could still work with Kaiser. You know, I think you follow what I'm saying. Some of the common questions here are, do I need to re-enroll since I'm already with Kaiser? The answer is yes, because through your retirement process, we have you re-enroll. And then secondly is the common question is, you know, are the plans exactly the same? And the answer is no, we're in a different stage of life, right? We're not going to be bearing children, probably visiting the doctor more diagnostics. So the plan is more tailored for where we're at in life. You know, we're in the retirement stage of life, right? We're not 25 anymore, okay? So the plans are a little bit different, tailored more for where we're at in life. And then you see also we've got some Medicare plans, okay? So, you know, all of us, what I hope for all of us is we have a nice long retirement. We live well past 65, and, you know, these Medicare Advantage plans will be needed, and we'll be appreciative that LACERS offers them. So one of the things I try to live by is that nobody, you know, plans to fail, they fail to plan. And one tripping point that we see from a lot of retirees is they don't really think about medical plan costs in situations where they're going to be living out of the area or out of California, out of the state. You know, LACERS is negotiating medical plans and dental plans. And surprisingly, many retirees stay right here in Southern California. So there's just more plan options and all that. So, you know, if you're looking at moving out of state or out of the country, you know, by no means let anything that I'm saying, you know, mess with your plans. But just understand that, you know, I should look into this. How much will my plan cost if I live in Italy, if I live in the Philippines, if I live in Spain? You know, what are those costs looking like so I can make the best plans possible and account for that, okay? You know, I have one story of an individual, and I don't like repeating it, but I do it just to help drive home the point. This individual worked with the city for many, many years. He moved to an area that was outside of any HMO medical option, and that wouldn't be a big deal, but he had went and bought a new house that literally took his entire monthly retirement allowance. So, I mean, you take that house and his food bill and his car note, and that was his money. And so when he found out he had to pay for a PPO plan based on what he needed, it's really difficult because now he's in a tough situation financially because of this choice, okay? And he's already in the house. He's not really able to move, and it's just a tough point for him. So what I'm really getting to is just understand if there are any costs for you based on where you'll be living, based on your needs. Just understand that so that you can plan appropriately and not be stressed in retirement. You know, we don't want you to be stressed in retirement any more than retirement has its own stressors, right? We just don't want to make it worse for ourselves, and LACERS doesn't want it to be worse for you. So just look at medical plan costs and understand what they are, okay? Dental and vision plans, again, on the dental side, we see Delta Care, great. We're using them today. And then on the vision, we see that it depends on the medical plan we choose, okay? So in retirement, you know, currently it's not IMED, it's based on the medical plan you choose. There's also no separate premium for vision coverage. So health enrollment at retirement, the first bullet, it's not automatic because some of you won't need LACERS. Maybe you have a better plan available through your spouse, for example. Okay, so we don't force the health plans on everyone because that'd be expensive and useless if some people are never going to use it. Okay. Second bullet, you can technically enroll in a LACERS plan within 60 days of your retirement date. I don't suggest that. I suggest that if you plan on using LACERS in retirement, just go through the normal enrollment process during retirement. I mean, you know, what good is it to say I'm gonna do it within 60 days and then 11 days into retirement I fall down and break my knee and I got no coverage for it, right? So if you plan on using LACERS health coverage, just sign up during your retirement process. It's seamless, it's not difficult, And that way you've got no gap in coverage, okay? And finally, if you don't enroll in the plan when you retire, it is a lifetime benefit you've earned. So you can enroll later during open enrollment or if you have a qualifying event. So just don't believe that, oh, I have to enroll it when I retire or else I can never enroll. That's not true. It's a lifetime benefit. Okay, so this next part, MPRP, is really for those of you that are using or tend to use an HMO medical plan, and you're going to be living outside of California or one of our covered zip codes, okay? So what I'm really trying to say is, if you plan on living in Southern California during retirement, you can just tune me out for a minute. But if you're going to be moving to Northern Idaho or Wisconsin or Florida, and you tend to use an HMO, then this might perk your ears a little bit. So the Medical Premium Reimbursement Program helps you pay the premium of your own chosen plan with your LACERS medical subsidy. You're basically eligible because you reside outside of one of our covered zip code areas. So for most of us, that means we're within the US, but we're outside of California, okay? So how it works, and we'll go over an example that's pretty clear cut in a moment, is you're basically enrolling in your own federally qualified plan, okay? And you're paying premiums directly to that plan provider, but the reason you're doing it is because you can save money on your monthly premium cost, okay? So without further ado, let's go through the example to kind of help it make it a little more crystal clear. So you're gonna plan to live in Washington State, right? And you see there's a Kaiser Permanente there and you wanna enroll in them, and you find out it's not part of the LACERS Kaiser Permanente plan, okay? Because we're only contracted with Kaiser California, all right? You contact us at LACERS, you verify the zip code is outside of our area. So this is then where you contact Kaiser Permanente in Washington, you enroll with them directly, you pay them directly, okay? At the same time, you fill out some required paperwork that we have at LACERS, and then you're always sure to send us proof of these payments you've been making to this Kaiser Permanente medical plan in Washington, okay? And then the bottom of this, what I did not cover, apologies, is that we would reimburse you up to your maximum health subsidy, okay? So, when you look at our health benefits guide and you see what the cost is, for example, of Anthem PPO, which is a common offering if you're living outside of California in retirement with LACERS, you may look at that price and get some sticker shock and go, what else is out there? I'm okay with an HMO plan. What can I do? And what you can do is MPRP. So yes, you got to pay up front and wait for a reimbursement, but if you're saving hundreds of dollars over the long run by doing that versus taking Anthem PPO, then, most people are going to say, yeah, that's for me, okay? So typically, again, you're okay with using an HMO, or you've historically used an HMO, and now you're going to live outside, out of California. Okay, that's our typical MPRP participant, and they're happy to save money instead of having to have enrolled in an Anthem PPO plan. So enrolling at retirement, let us know that you're going to be living out of state. Or again, if you're going to be in a rural part of California, that could apply too in some cases. Provide your zip code to us so we can determine that yes, you're eligible. And then we'll provide you with the forms to enroll, the reimbursement schedule, which is quarterly, and educate you on how you can make this work for you. Now, not everyone immediately says they're moving out of state upon retirement. Sometimes it's after you've already retired. So maybe you just, for old time's sake, wanted to smog your car a few more times, and then you said, you know what, I've had enough. I'm tired of smogging my car and I'm ready to move, okay? Let us know that you're moving out of state and we'll confirm the same thing for you and help you if you're interested in participating in the MPRP. One thing we don't do though is we don't help you find a medical plan where you live. That part is on you, just so you have the right expectations, okay? But we do help with regards to letting you know about the program and making sure you get reimbursements on a quarterly basis. So when to enroll in a medical plan, again, it's not automatic, but you can do it during the retirement process. It's seamless, it's not difficult, and that way you have no lapse in coverage, okay? And, just in case you're wondering how that works, your active city coverage will keep you covered until the end of the month in which you retire. So if I retire on, February 15th of 2021, my active city coverage is going to keep me covered the entire month of February. And then come March 1st, I'll have my LACERS coverage because I was sure to enroll during my retirement process. Qualifying events or changing plans, of course, you can do that during open enrollment. You can do it within 60 days of turning 55, 90 days of 65 because of Medicare. And of course, qualifying events, very common, for example, is moving. I'm moving out of state. Never mind, I like it in California, I'm moving back and things like that. Okay, so these are all ways that you can change your plan. So Medicare, you know, some individuals retire at 55 or 57 or 59 or 61, and they're not too worried about Medicare, but we have a lot of individuals that retire near 65 or even after into their 70s and even 80s. So we are going to cover that a little bit today. So what is Medicare? Medicare is a federal insurance program. Okay, and most of us are going to age into Medicare, meaning we turn age 65 or older. Okay. LACERS does have a specific Medicare requirement. If you're going to use one of our plans, you must enroll in all parts of Medicare that you're qualified for. If you don't do it, that gets you into some hot water. And we'll talk about the hot water, don't worry. So your subsidy amount is calculated differently once you age into Medicare, and you can see that on the slide. So you see that with 20 years of service credit, you're at 100% of the one-party monthly premium. Now, I'm personally no math whiz. I mean, I learned math to pass city exams, then I forget it as quickly as I can. So I just like to go into the book and look at the dollar amounts, and that'll tell me what my costs are or are not, okay? But we've got it here on the slide for you as a percentage. Required Medicare Part B. Okay, so all LACERS, retired members, and dependents, upon turning age 65, must enroll in Medicare Part B. Part B is in Brian, okay? And you got to provide proof of enrollment to LACERS. So do we have retirees that don't enroll on time? It can happen, although if you retire prior to 65, we really let you know you need to enroll. We also see, though, that some individuals don't pay their premiums on time. So whether you don't enroll or you don't pay on time, it can terminate your LACERS coverage and subsidy. I can't understate what a nightmare this is. I don't send out these kind of letters, but I used to work or sit near our health advocates. They'd have to draft up these letters to the effect of, you know, dear Mr. Johnson, you know, we received word from Medicare that you haven't been paying your Part B premium on time. We have to terminate your LACERS coverage, and we also have to terminate your subsidy. So there's an amount you still owe to Kaiser because you had coverage without a subsidy. So you don't want to get that letter, and you don't want to be, you just don't, okay? So just, be sure to enroll on time and to pay. You enroll directly with Social Security, okay? You don't enroll in parts of Medicare with LACERS, okay? The basic Medicare Part B premium is $144.60 per month, okay? And just to give you a little more peace of mind, you can consider enrolling in the Medicare Easy Pay program, okay? And that way you can have any Part B premiums deducted directly out of your checking account, okay? Medicare Part A, you will only enroll in if you get it for premium free, okay? So stepping back a moment, Part B, I got to enroll in, I have to pay for it. There's no way out of paying for it, okay? Part A, I only enroll if I get it for free. How do you get it for free? There's the 3 ways listed here on the slide. 10 years of earnings history with Social Security outside of the city. So I worked with McDonald's for 10 years, Starbucks, or any combination of these private companies for 10 years. I can get Part A premium free. Or, as the years go by, many more of us have started after April 1st, 86. You'll notice on your deductions, on your payroll deductions, one of them is FICA Medicare, or through your spouse. So maybe your spouse worked 10 years in the private sector, or maybe your spouse started after April 1st, 86. Now, you may have read those 3 requirements and said, you know what, I don't actually satisfy any of those. I've been with the city since '84, and my wife was a homemaker. So what about me? Well, if you don't qualify for Part A, you don't enroll in it, right? We said that earlier. Your LACERS plan will still cover hospitalization costs. The main difference is that you don't get a Part B premium reimbursement, and there's no change in your formula. So let's jump back to the happy camper with a smile on their face because they qualify for Medicare Part A premium free, so they enroll in it. You've just made LACERS medical plan coverage cheaper for LACERS because Medicare becomes your primary payer on all your hospitalizations, which I'm hoping you don't have. But if you do have them, Medicare has to foot most of the bill. So, we're not a private enterprise, we're a public enterprise. And when there's savings, we can pass that back. So LACERS reimburses you for your Part B premium. Now, make no mistake about it, okay? You're always paying your Part B premiums. We're simply reimbursing you for the basic premium. So don't ever think, I enrolled in Part A, I'm done, LACERS is gonna pay these people. That's not gonna happen, okay? But again, the good news is by you enrolling in Part A and Part B, LACERS will reimburse you for that Part B premium. So, I can do that kind of math. I'm good at that type of math. 144.60 times 12. That's called a lot more groceries, a lot more gasoline for my vehicle, and maybe a weekend trip. Okay, so I'm all for this. Another thing worth noting, LACERS does not reimburse dependents or survivors for that Part B premium, just you as the member. Another tripping point, Medicare Part D, do not enroll in a non-LACERS Medicare Part D plan. There's no dual coverage in your Medicare years, okay? So if you've been a dual coverage person your whole life, which in many cases can be a good idea because then, I've got my medical coverage, I'm also on my wife's medical coverage, and so they come in and I don't pay a lot of co-pays and I don't pay a lot of claim costs and things. Just understand that in Medicare age or Medicare years, there's no dual coverage. The last plan you enroll in wins. So here I am, I've got this great LACERS plan, I'm happy as can be, and someone approaches me about Part D during my trip to the doctor, and they tell me how I could be saving $5 every time I fill a prescription. And I'm a retiree, so I'm always concerned with my financials. I say, hey, you know what? I'm filling a lot of prescriptions. I could use that $5 savings. I can use that. So I enroll in it. Well, unfortunately, Medicare receives that and goes, oh, look, he doesn't want this other plan. He wants this new plan. So goodbye to the old plan. So there goes all this coverage, this expansive coverage in place of a prescription drug coverage that I already had on my own plan with LACERS. I wish I would have talked to LACERS before I made this mistake, okay? But we're trying to tell you now. We'll tell you again during retirement. We also have Medicare seminars a couple times a year. We'll tell you then too, okay? So don't make the mistake of signing up for Medicare Part D separately. When should you enroll in Medicare? So if you're retiring before age 65, LACERS requests that you start enrollment 3 months prior to turning 65. We mail you an agent packet letting you know what to do because we know your birth date, okay? If you're retiring after you turn 65, we're gonna provide you with a special enrollment form to avoid any lifetime late enrollment penalties, saying, you know what, Mr. Smith has always had his coverage through the city this entire time. There's a good reason why he didn't enroll in Medicare Part B until now. I also say that because we have many, many individuals that keep working for the city past 65 and 70 and into their 80s. They're good at their job, they love their job, and we at the city are blessed to continue utilizing their experience and all that they know how to do, okay? So again, you're retiring after 65, we'll provide you with the necessary form so you can avoid any type of penalties. And again, we got to remind you at the bottom of the slide, if you enroll in a Medicare plan outside of LACERS, it's going to terminate your coverage. So you can tell this is important because we've already mentioned it twice. LACERS Well is a free program once you retire, and it's to help you, keep as healthy as possible in retirement. A lot of individuals really like this. They can only travel so much and they can only attend so many family outings before they want to do something a little bit different. LACERS Well helps them cultivate friendships and learn some ways to keep themselves healthy and happy. I mean, I'm an ex-athlete and I got to tell you, looking down, I need to do something hopefully before retirement, but at the very least when I retire, okay? And I'm looking forward to LACERS Well, giving me some good information and opportunities to do such. Legal planning. All right, so we're going to talk about things like power of attorney and why that's important, and keeping your information updated so LACERS can reach you and doesn't have to stop your monthly retirement allowance from being sent to you and things like that. So during life, you want to think about things like power of attorney, living trust, living will. You know, we accumulate assets through our lifetime, many of us. You know, whether it's that home that you're paying off or have paid off, whether it's that Vanguard mutual fund that you keep adding to, you know, your deferred comp and all these things. So it's important to think about, you know, from a legal standpoint, do I have things in place in case and when things do happen? Okay. And then we're living longer. So when it comes to things like long-term care insurance, you know, do you have family close by that's willing to help you when you can no longer get your own groceries, clean up your own home, you know, bathe yourself, use the restroom, or am I going to need someone to help me with those things? Should I invest in long-term care insurance just in case? So these are things that you will want to think about. And then after death, you know, a big, huge part there is taxes. You know, as I accumulate wealth, you know, the last thing I want to think about is my wife and kids giving all their money to Uncle Sam. Okay, that's like a nightmare for me. So I'm always looking at ways of, okay, you know, what's my game plan here to avoid taxes on these specific items, okay? Because I do not want Uncle Sam taking my kids' money. No. So durable power of attorney. So LACERS has a special durable power of attorney. It's a legal document where you designate someone to act on your behalf regarding your LACERS benefits. Now, you may look at this and go, wait a minute, I don't need that kind of help. But, you know, things happen. What if you get into a car accident, for example, and you're incapacitated? You're still alive, right? But you can't talk, for example. You know, what this power of attorney does is you've designated someone else that can speak on your behalf, okay? So this is very important. We did this at LACERS because we had many, many retirees that would get into difficulties where their family was trying to genuinely help them. You know, I'm calling, you know, my uncle's been in an accident. We need to change his address. We had to move him somewhere else, and we want to make sure he's getting his checks and such. And we said, we can't because you're not the member. So a power of attorney really alleviates that kind of issue. We also realize, though, that a lot of you are not just with LACERS as far as what you have in your life and what you need a power of attorney for. So you can also visit the state of California's website to look into getting a power of attorney that is more, you know, covering everything else in your life. And we really believe you should have it at a bare minimum, the LACERS power of attorney when you retire, which will help you during your retirement with getting completed. And also that you consider and have a California power of attorney. Now, these are very basic power of attorneys. You can also, many of you probably have gone to a lawyer and do that route because it needs to be more complex. But these are just some options that are available to you. Don't mistake this as LACERS helps me set up my power of attorney for all my personal finances. You know, LACERS has a LACERS specific power of attorney. And the California option we're showing you here is so that you can consider at a bare minimum having something that covers everything in case something happens to you where you're incapacitated. Always keep LACERS in the know when it comes to where you're at as far as your mailing address and your best contact phone number, okay? Something else that's nice, look at this bottom bullet. If you have issues with your health plans, contact LACERS. That's nice to know. So I go and, you know, Anthem works on my foot and I'm walking away thinking, okay, $3,000 out of pocket, no big deal. I looked at my medical plan coverage and I get this whopping bill for $12,000. I'm like, what happened? I call Anthem and they're not listening. They don't get it. They don't get what I'm saying and I don't get what they're saying. I'm calling LACERS. Hey, I'm having issues with my plan. Can you take a second look? And then LACERS can let me know that I'm wrong, or maybe LACERS finds an Anthem issue. Okay, so this is a really good benefit to have, okay? If we can't contact you, we're worried about fraud, okay? LACERS is always stopping fraud because that's the best thing to do to protect all of us in our retirement. So if we can't reach a retiree that we're sending monthly retirement to, we're concerned. Have they passed away? Is someone taking this money? Things like that. So we'll stop the payments until we hear from the retiree. So, you know, just let us know if you move. Let us know if you got a new cell phone number and things like that. After you retire, this is how we communicate with you. We also didn't list it here, but we also do email. So we send you mail, we send you emails. We have our revamped website that's really good. I suggest you all visit lacers.org. for the questions that you have. It's got a search function. We've cut out a lot of unnecessary information. I think you'll be very pleased visiting lacers.org these days. If you don't already have MyLACERS, we've sent your PIN. You should get that in the mail within a week. And then you can use that to set up your MyLACERS account online. You're also much more secure having a MyLACERS account versus not having a MyLACERS account, okay? They do show that people that have online account access know more about their accounts and see changes more quickly than people that don't, okay? And LACERS well also communicates with you to give you that good information to maintain your health in retirement. The different ways to reach us, we have our 800 number. If you just want to know something, I suggest email, meaning, you know, it'd be nice to know if something, I'm sending an email, okay? Just because call volumes can be high. You know, we've got the SIP program going on, a lot of people asking about retirement and furloughs and such. So, you know, if it's just a nice to know thing, I typically suggest sending an email. You'll get your response within a day. It's in writing, and you've always got it tucked away somewhere in case you need to look at it again. For now, please don't visit us at the LA Times building because we're not accepting in-person contact because of COVID-19. You can always still mail us information if you need to. And again, our website is important as well. There was a couple other things that were recommended from your department to discuss today. We don't have slides to them, but I figured I'll still cover them. The first one was what is a 1099-R? And a 1099-R is basically the document that'll help you with filing your taxes. And that will list all the distributions you received from LACERS. Okay, so LACERS will send you a 1099-R at the end of January for the year prior, and you'll typically hand that over to your tax preparer to assist with the filing of your taxes. Okay, the other thing was that there was a request to understand what is a verification of benefit. So verification of benefit, you know, in retirement, you may not think about it now, but you may decide to buy a new home or to buy a car, and you need some kind of proof of income letter. And that's basically what a verification of benefit is. You know, we can say things like, you know, Mr. Jones receives $5,800 a month through LACERS. So that's what that is. And to request that, you can request that on our website. So those are two things that were just a special request from your department, just to cover off on before we concluded. So I'm going to stop my screen share. And as I mentioned to you, I'm going to show you a couple of our common medical plans. So let me get that up here. One moment. So almost there. I'm just opening this up and getting to, first I'm going to cover off on the individual covering themselves. So these are just two of the most common medical plans that newly retired you know, LACERS members find themselves choosing, and that's why I just want to cover it, because we don't have really time to cover everyone's specific medical plan, cost and coverage, but we can at least cover a couple of them. So I'm just getting there real quick. Appreciate your patience. All right, so I'm just about ready here. Okay, so one of the very common coverages that we see upon retirement is I'm just covering myself, okay? And I'm not 65 yet, you know, I'm not Medicare age yet. So let's just talk about how to read this really quickly. So you've got Anthem PPO option, and you've got some HMO options, Kaiser and Anthem, okay? This amount that's the blue backing with the white text, that's the amount, the monthly premium if you had no subsidy at all, okay? And then you have your subsidy. So you don't see the subsidy on this slide, but what you do see is the amount that the plan would have cost with no subsidy minus whatever your subsidy is, and then you've got your actual deductions based on your service credit, okay? So for example, if I'm covering just myself on Kaiser HMO and retirement, and I have 12 years of service, okay, I'm not paying anything, all right? And if I'm gonna choose Anthem PPO, then with 18 years of service credit, I'm not gonna pay anything, okay? Because as I mentioned in the beginning, it's cheaper to cover just yourself on a medical plan. All right. The other one I'm going to cover before we open it up to just general questions that you may have is another quite common plan in retirement, which is I'm retiring and I'm covering myself and my spouse, and we're not 65 yet. Okay, this is pretty common as well. So again, you have the cost here in the dark blue with the white text of if you have no subsidy at all. And then here in the body of the page, you see what the deductions are. So I'm going to cover myself and my spouse on Kaiser HMO. I've got 24 years of service credit, and I don't have a monthly premium. Now, I worked with the city for 43 years, but I'm moving out of state, and I don't want to do MPRP. I'm just going to take a PPO plan. Oh, I'm paying $747 a month. Okay. So this is the type of situation where someone says, you know what, I'm living in Northern Idaho, I'm living in Wisconsin, and I'm okay with an HMO. I think I'm going to go shop my own plan and get reimbursed because I bet I can pay a lot less than $747 a month for medical coverage for myself and my spouse. Okay, so those are two of the very common plans that we see, you know, right out of the gate in retirement. So I'm going to stop share and open it up for any questions that you may have. So I don't see any questions currently. I'll give it another minute or two. Okay, so the questions coming through is, can you remove a dependent coverage in the middle of the year? The answer is yes. You could also remove yourself from medical coverage in the middle of a year. Just understand though that your coverage is gone until at the earliest next year. So, you know, you can do that, yes, but again, let's just talk about it, okay? I delete my dependent in May because I just want to save a little money, and in June they have something happen and they need coverage and they don't have it, you know. So, but the answer is yes, you can remove a dependent in the middle of the year. Just hoping that nothing happens in the meantime if they don't have any other coverage. Do we have any other questions? I'm going to give it another minute. In the meantime, I'll let you know that we will be sending you a survey link within about a day. I always tell people to let us know how we can improve, but also please let us know what you like, because as we're looking at making changes in our seminars, we don't want to remove things that people say over and over that they like. So, you know, we like to hear, you know, about your experience. We'll make your experience the best it can be. Let us know, you know, what you like, what you don't like, if anything, either way. All right, I got Part B, but I have not paid anything. Got it from Social Security. I would say, I'm not looking at your record right now, but I would say that they've probably removed the Part B from your Social Security benefit. Or you've very recently enrolled in Part B and you haven't been charged yet. But again, everybody pays for Part B. I'd also say make sure to check your Medicare card and make sure that you do have Part B. You may just have Part A and think that you have Part B. Okay, so that's what I've got to say about that. Do we have any more questions before we conclude? Okay, can you tell us the link where the presentation is present on LACERS.org? Yes, you go to active members and you look at the planning for retirement section, and you see the dates of our upcoming seminars. And when you click on that article, it's going to come up for you. Okay, so I got Part B 2 years ago. Okay, so if you have Part B, I would ask that you review that with Social Security. Also, if you're not retired from the city yet, you're not yet required to have Part B. So if you're paying for it, you're essentially overpaying for coverage you don't yet need, okay? And then the same individual asked, should I follow up with Social Security? And I would say yes, definitely follow up with Social Security, confirm you have Part B, see where they've been taking the Part B amounts from. Maybe they're taking it from your checking account or possibly from your Social Security payment. All right, so inevitably, you're gonna have questions come up after this. Feel free to reach out to LACERS. Also, don't make this your only, visit to LACERS for a seminar, okay? Yeah, we have people that we call frequent flyers because as they get close to retirement, they attend a lot more seminars, and we actually love to see that because we do want to make sure you make the most informed decisions, have the best retirement possible. Let's see here. The same individual with the Medicare Part B says they're not retired yet, so that concerns me because I just don't want you to be paying for Part B that you don't need because you've got active city coverage. So do check with Social Security, and if you're not close to retiring yet, if it was me personally, I wouldn't want to be paying for Part B coverage until I'm retired. We have a question, is there a SIP seminar planned? We already had some department-specific SIP presentations. If you're part of SIP, congratulations. It's great to be getting an incentive to retire. And if you're planning to retire anyway, what could be better than more money? What's going to happen for those of you that are part of SIP, you will be contacted at a minimum 4 to 6 weeks prior to your retirement date and assigned a retirement counselor from LACERS that can assist you with the information. I don't want to make any promises, but I do know that we had a department-specific SIP for LAWA, and they did have a group session at one point to discuss the retirement process. But I can't venture to say yet if that's guaranteed, if you're in the citywide SIP, okay? But just rest assured, number one, you're going to be given advance notice of your retirement date. Number two, you're going to have a dedicated retirement counselor to make sure that you're completing all the paperwork and have all the information you need to make the best decision. All right, everybody. On behalf of myself and Heather, we really appreciate your time. We're going to go ahead and wrap up for the day. Thank you so much. We wish you the best, and we hope to see you again. Take care and have a great day. Bye-bye now.